Morning, everybody. Let's go ahead and get the meeting started. This is Police and Fire Department Retirement Plan and Healthcare Trust Board meeting for March 5th, 2020. Go ahead and do a roll call real quick. Myself, Andrew Gardner, is present. Vice Chair Drew Lanza is present. Trustee Howard Lee's absent today. Trustee Eswar Menon present. Trustee Nick Muyo present. Trustee Vikas Oswald present. Trustee Richard Santos present. Vic Senseri is going to be absent today. And Trustee Franco Votto is present. I assume City Council will be here. Pam Foley will be here a little bit later. We got our council here, Harvey Lederman, CEO Roberto Pena. We got our CIO and our COO, Prabhu and Barbara here, and the rest of the staff. Thank you for all being here. For order of this day, there's one order of the day. I'm just going to turn it over to Harvey for an introduction.
Thank you very much. Good morning, members of the board and staff. Many of you know that my colleague who has worked with you for a number of years, Jeff Rieger, has accepted a position as chief counsel of the Alameda County Retirement System. And after 15 or 16 years of working together, he and I are parting company, although they're a good client of mine, so and of our firm. So Jeff will now be in charge of me. A scary thought for both of us. But I wanted to take the opportunity to introduce my partner, Jenny Krangle, who will be working with me for San Jose Systems. Jenny has been introduced to the Federated Board at their last couple of meetings. And I just wanted to let you get to know Jenny a little bit and know that you will be seeing her as well as me. I'll let Jenny make a self-introduction.
Thanks, Harvey. Nice to meet all of you. Thanks for having me. I've been representing public pension systems for about 20 years on tax and fiduciary issues. I love this work. I think it's really important work that you guys are all doing, and appreciate being able to partner with you. I was in-house with CalPERS for a while. Harvey was my fiduciary counsel when I was in CalPERS, so I used to be in charge of him once too, like Jeff will be now with us. But that experience was really great for me in terms of, really understanding how the operation works internally, and it informs how I advise you as your outside counsel. So look forward to working with you, and I'm happy to be here. Thanks.
Welcome. Thank you.
Thank you, Mr. Chairman. Appreciate it. Any questions?
Jeff, our best.
Yo, thank you.
He's
Absolutely.
always made me feel very comfortable and always helpful,
Good.
and welcome aboard.
Thank you very much.
Yeah, welcome aboard. Thank you.
Oh, and let me at this time also warn Jenny, if I didn't do it before the Federated meeting, that the mics are hot. And if you want to protect yourself.
All right, we got one item, one sunshine that we need to waive, which is item 4C, attachments 2 and 3. Discussion and actions on the Officer of Retirement Services proposed administration budget for fiscal year 2020-2021. We got motion by
Second.
Santos, second by Oswald. All in favor?
Aye.
All right, that passes. On to the consent calendar. Is there any items on the consent calendar that anybody would like to pull?
Motion to approve.
All right, got a motion approved by Santos, second by Votto. All in favor?
Aye.
Aye. All right, that takes us to 2A, oral update from our CIO, Prabhu Palani.
Thank you, Mr. Chairman. I am going to start on a lighter note. So my son plays varsity basketball for Mission San Jose High. I'm going to get you at it. So I was there to support him and his team recently, and guess what I found? Exhibit A.
Are you serious?
So the all-time leading scorers of the Mission San Jose Warriors. And number 4 on the list.
Dude, I didn't know this.
Number 8 is more
Pretty
important.
good, man. You're still on the board. Good for you.
I'm sure the Golden State Warriors can use our chairman services at this point. So,
I can validate, big shoes to fill there.
Andrew, way to
and
go.
on good authority, I was also told that he did not play his senior year, and despite which, he still is a number 4 on the list. All right. I'm sure you will. All right, market volatility and coronavirus. I'm sure everyone's eager to talk about that. So, obviously this is a black swan. None of us expected. We all thought market was elevated, and we've been thinking that for a number of years. We didn't know what the catalyst would be for a sell-off, which is why it's a black swan. So firstly, we have some very approximate return numbers here. Obviously, we had to proxy the private markets. So our returns for last month, assuming that the private markets followed the Russell 3, police and fire was down about 3.1% for the month. And S&P 500 was actually down 8.23% for the month, which is why we run a well-diversified portfolio, which is why we don't put all our money in the S&P 500. Interestingly, the Russell 3 was down 8% last month, and emerging markets, at least was surprising to me, were actually only down 5.5%. So emerging markets actually outperformed US markets by about 250 to 300 basis points. So we don't have, obviously it's early days, we don't have accurate numbers yet. It'll take a while. But we are short duration compared to a lot of our peers, and bonds have actually rallied, so that's going to hurt us, our performance relative to peers. But the fact that we also have short equity weighting compared to a lot of our peers should actually help us. And the fact that we have 15% in short-term fixed income should help us. The fact that we are also overweight emerging markets compared to a lot of our peers should also help us on a relative basis. I mean, we've all lost money, but we would have lost less money than many of our peers last month. And of course, this week, as you've seen, we've had 2 days where the gain was almost 4 to 5%, 1 day of sell-off, and again, today the market seems to be selling off. So high volatility. We went back and looked at 5-day returns of greater than 10% drawdown over the last 20 years. And not surprisingly, it happened in 2000, April 2000, with the NASDAQ correction. 3 of those events happened, and then happened September 9/11. 3 times it happened in 2008, 2009, once in 2015, and again last week. So these are very unusual moves in the market. And so we should stay the course because the market usually bounces back in the long run after these sharp drawdowns. We don't do tactical asset allocation here. I don't think we necessarily have the skill to predict market movements or time the market. Having said that, I think this sets up well for our discussion on strategic asset allocation later this month in front of the investment committees. And if we do want to gradually increase risk and get closer to our peers, this is as good a time as any. So we will frame the discussion appropriately in a couple of weeks when we come in front of the IC and offer some options for strategic asset allocation. Now, going into that week, last week when there was a sharp drawdown, we were slightly underweight our strategic asset allocation, so that helped us a little bit. And on Monday, we actually rebalanced back to target weight. Every Monday, we rebalance, we use Russell and their overlay program to do that. Those are my comments. I'm happy to take questions about volatility and the coronavirus and our approach. If not, I have a few other comments to make. Yes?
I got one question. When you talked about strategic allocation, within that 10% corridor that you guys have, moving within that corridor, do you consider that strategic allocation, or are you talking about outside of that and sort of changing the allocation?
Yeah, good
altogether?
question. So staff does have leeway to go plus or minus 10% of the target weight.
Yeah.
So for example, if our equity weight is 30%, we can be somewhere between 27 and 33. That was actually put in place not to allow staff to make decisions, but more because we don't need to frequently rebalance and incur transactions costs. So to let the weights drift a little bit because of market movement. Having said that, any change within that, I would consider tactical.
Okay.
And so when I talk about strategic, is to come back to the board and say, we're running this at 12.5% risk. Should we be thinking of going to 13%, which will actually impact our strategic weights?
Okay, thanks. Any other questions? Go ahead and continue then.
Okay, so a couple of other things. Part of my job is to educate the boards, to bring outside speakers, and then when we present you with options, to make sure that you all make well-informed decisions. And to that end, I do invite outside speakers. You will hear later today from a panel of experts on ESG education. Fortunately or unfortunately, we have two boards, so I have to spread the wealth, and sometimes it's hard to get the same speaker to come to both boards. Having said that, we're very lucky that our ESG panel actually presented to the Fed board last month, and they're here to present in front of you today. But we do have, and since these are public meetings, on March 19th at the Fed board, and we have a number of new trustees on the Fed board, so I thought it was important to educate them on asset allocation. So I've actually invited your very own Jeremy Evnine to come and talk about asset allocation to the Fed board. And joining Jeremy will be Myron Scholes, who is a professor at Stanford, the 1997 winner of the Nobel Prize for Economic Sciences. So I personally find it fascinating to talk to Myron every time we meet. And so I think if you have time, you may want to attend that meeting as a public member, and of course these are all streamed, and so you can also watch these meetings. And we'll also have Rui Figueiredo, who's in the Global Investment Committee of Morgan Stanley, presenting to the Fed board. And he's actually presented to the Police and Fire Board a couple of years ago at an offsite. So again, I try to bring in speakers, and I try to spread the wealth around, and hopefully we'll have speakers in front of the Police and Fire Board in the next 3 or 4 months. With that, Mr. Chairman, we are still waiting for one more speaker on the ESG panel, so unless there are questions, I suggest that we go to performance updates.
Okay. Sounds good, and I'm okay with that. So yeah, let's go ahead and take this a little bit out of order. We will go ahead and skip to, we'll do C, D, E, and F, and then we'll come back to 2B, which will be the ESG. So item C, quarterly reports from Neuberger Berman. Are you guys on the phone? Casey?
Yes, this is Casey Boyer. I'm on the phone from Neuberger. Can everyone hear me?
Yes,
Yes.
we can.
Okay, great. Sometimes it is hard for me to hear you all, so if you do have questions, please just interrupt me and feel free to use a louder voice than normal. But I will go ahead and get started. Thank you again for having me. We appreciate the opportunity to give you an update quarterly. If you turn to the first page, I'll go through some high-level statistics of the overall portfolio. This includes both what we have called legacy portfolio, which is all private equity investments made prior to the NB relationship, and then the Neuberger strategic partnership, along with combined information. Obviously, on the legacy information, no new investments were made during the quarter of Q3. Performance basically the same. There were some distributions pushed out during the quarter. In terms of Neuberger Berman, it was a quarter where we made some additional investments. So we made 2 additional primary fund investments, taking the total to 21. We made 2 additional co-investments, taking the total to 19. As a reminder, this program was started a little over 2 years ago, 2.5 years ago. So as of Q3, we were a little over 2 years into the program. With the additional commitments that we made, it was a total of $40 million. So the total commitments that have been made on behalf of police and fire to date is $200 million. During the quarter, it was a fairly heavy capital contribution quarter. So the total amount that has been contributed to date is $73.7 million. Approximately $25 million of that was in Q3. Performance on a net basis for Neuberger, a net multiple of 1.1 times and a net IRR of 13.6%. Still early in the program, but happy to see that the portfolio has, started early performance, and we expect that to continue. Moving on to the next couple pages, pages 2, 3, and 4 are benchmarks of the performance of your underlying investments. So page 2 and 3 show all of the legacy investments, and then page 4 shows Neuberger investments. You can see the IRR and MOIC of each investment, and then to the far right, you see how their performance benchmarks against their peers, both on an IRR and MOIC basis. For the legacy portfolio, the quartiles from Q2 to Q3 were very consistent. None of them actually changed. So the portfolio, it's an older portfolio, 2005, 2006 vintages, 2012. So you're not going to see performance drastically change at this point. If you look on page 4, this is Neuberger's portfolio. As you can see, there's not a lot of investments that we actually can provide quartiles for at this point because they are not available. The first 2 investments are quartiled, and that quartiling is there. I'll point out the second investment down, which is at 4th quartile. This investment is a fund, and they've made 1 investment to date, which is held at 1 time. And they actually just announced another deal, but it has not yet closed. So there will be a second deal into that fund shortly. But as you can tell, this fund is being affected by what we call the J curve. So while the investments are not underperforming, there are fees and expenses that are being called. And so that's kind of why you're seeing that negative performance. Turning to the next page, the next couple pages show some diversification of your portfolio by vintage year. And if you recall, the goal at the start of this program was really to instill a consistent investment pace and vintage year diversification. So you can see Neuberger on the top right and how it will continue to develop as we continue to invest over 2020, 2021. The first page, page 5, is by commitment. So the numbers you see here and the percentages are based on the commitments that we have actually made in each vintage year. And then you can see the bottom chart there on page 5 is the combined portfolio, both legacy and Neuberger funds. You can see 2019 becoming a bigger piece of that overall portfolio. And, we anticipate that continued consistent diversification. Page 6 is the same analysis, but instead of using the commitment amount, it's using the net asset value. So essentially your fair value of investments. Again, developing nicely. If you look at the Neuberger chart on the top, last quarter, the 2019 percentage was 17%. It's now 35%. So it continues to add value as the diversification and the vintage year develops and matures. Turning to the next pages 7 and 8, really going through pages 12, it's breaking out the performance by different underlying metrics. So page 7 and 8 break out the portfolio by asset class, and this includes both the legacy and the Neuberger, and then obviously the combined investments as well. This 7 and 8 are showing the performance by multiple of invested capital, so it's the value of your investment compared to the capital that has actually been invested. If you look on page 8, you can see special situations as an asset class. The Neuberger MOIC is 1.36. That's largely been driven by one of our co-investments at this point. And then you'll also notice venture capital is at 1.06. Typically slow to develop, but also the one asset class that in the long run you would expect to have the potential to outperform. So none of this is out of characteristics. This is what we would expect at this point in the life of a portfolio. Turning to page 9, this is the same analysis using the MOIC or multiple of invested capital, using the investment type, so primary funds, secondary funds, and co-investments. These are the 3 types of investments that we use within your portfolio. Again, very much expected that secondaries and co-investments early on would be able to produce higher returns. And so that's a good thing to see early on in the portfolio and can be a good driver at this point. So pages 10 through 12, it's essentially the same charts. It's just using, instead of MOIC, it is using an IRR performance metric. So really at this point, tells the same story. And the final pages 13 and 14, this shows your performance at an underlying basis for each investment. So you can see which investments are driving the portfolio and which investments may be dragging it down a bit. If you look on page 14 towards the bottom, you can see percent of total. Neuberger is becoming a larger part of your portfolio, currently 35.6% of the overall commitments within your private equity portfolio. And if you look on the right, you will see the gross IRR and gross MOIC for each underlying investment, as well as by legacy, Neuberger, and then the total. So just a very good overview and very detailed couple slides to show underlying performance. And I think that's all I was planning to cover. I'm happy to answer any questions that you all may have.
So, if I may ask, on page 4, investment 18, where you have an MOIC of 0.05, is that because there's not much has been invested and the fees have been taken out?
That's correct. I believe they have not made any investments at this point,
Thank you.
simply based on, yes, fees.
Any other questions? Brian, you have any comments?
Not really. We keep doing what we say we're going to do and are getting the results that we would expect to get.
All right, if there's no other questions, thank you very much.
Yes, of course. Thank you.
All right, so that brings on to 2D, presentation of calendar third quarter for private markets report by Makita. Is Laura on the phone?
Yes, I am. Good morning.
Good morning, Laura.
Can everyone hear me okay?
Yep.
Yes.
Okay, great. So we have a new format for our private markets report and also our public markets report that you'll see. We have some new colors that are not just different shades of red and blue, so hopefully a little easier to read. So if you take a look at the private markets report, as a reminder, this is the public version. We do provide a non-public version with a bit more confidential detail to staff each quarter. And also, as a reminder, this is the third quarter report. Private markets are lagged, so it does not yet include mostly positive performance from the fourth quarter of 2019. So if you take a look, we start with the private debt program. We do have a summary of all asset classes on page 3. So you can see here on the far right, the internal rates of return for each of these private markets asset classes are quite strong. They total 8.4%. The laggard has been private debt because there's some legacy direct lending exposure in that portfolio that hasn't performed as well. But if you look at all of the more recently started and invested asset classes, if you look at Neuberger Berman, at real estate, at real assets, and at the legacy private equity, you see returns either close to the double digits or well into the double digits for IRRs. Starting with private debt on page 5, you can see commitments by vintage year. You can see that there were a lot of commitments in 2010, and those are those direct lending, sort of less risky, less true private debt commitments that are bringing down some of the returns. But all of the more recent commitments in past several years that we have performance for are doing quite well. I will skip ahead to page 7, and I'm going to go through more pages in this report than I typically do in a brief presentation, just because these are new exhibits for us, and I wanted to point them out. If you look at the recent quarterly cash flows on page 7, you can see distributions from the program in green and contributions in blue. So you can see that this is a relatively mature program that is making more distributions than calling contributions right now. If we take a look at page 9, you can see performance by vintage year. Overall, there's been 12 commitments made in the private debt program, 530 million committed, 470 of that has been contributed, and 366 million has been distributed. If you look on the far right, you can see in the third column from the right the internal rate of return for each vintage year for your program, and then in the far right column, the benchmark internal rate of return. This is the Cambridge Associates Credit Opportunities universe. Benchmarking is a little bit difficult in this space, but we think this is the most appropriate. And if you look at the more recent vintage years that are meaningful, say 2015 to 2017, where the current staff that is in place now has been making commitments, you can see IRRs for your funds have been exceeding benchmark IRRs. I will skip ahead then to slide 12 and look at fund performance sorted by individual strategies. And the same story is true if you look at the internal rate of return for your funds individually relative to benchmarks. Recent performance has been quite strong. We do show a little bit more granularity on the following pages around diversification by vintage year, which is always a goal of ours. You can see that on page 13. And then also diversification by geography, which is on page 14. And there's a little bit here, you can see that there's more exposure to Western Europe because recent commitments to cross-ocean in particular have been more Europe-focused. We can skip ahead to the real assets program that begins on page 18. And you can see here, if you take a look at page 21 in particular, where we have contributions below the line in blue and distributions in green, that the program in real assets has really been getting up and running more recently since the second quarter of 2017. So it's a less mature program with a lot more being called in contributions than being distributed so far. And then on page 23, you can see that only 1 year of this program, because it's so new, has meaningful returns yet, but they're quite strong. The 2016 vintage year, which is made up of 2 infrastructure funds, has had an internal rate of return for your program of 12% relative to 7.5% for the peer median. We have the same sorts of other analysis in this section, but I won't go through page by page in the interest of time. But on page 26, you can see the 2 funds that are contributing to those strong 2016 returns, the infrastructure funds, Brookfield and Global Infrastructure Partners. Brookfield in particular has posted quite strong performance since you hired them. We have those same fund diversification slides on pages 27 and 28. You can see that much of the exposure that's been called so far, because this is a relatively new program, has taken place in vintage year 2016, and that much of the exposure is global developed equity. The real estate program has also had quite strong returns. It begins on page 32. And in particular, I'll point your attention to page 35, and you can see that this program is neither sort of mature nor immature. It's sort of been going along at a steady state, which is sort of what we hope to see with all the programs going forward, where in some years you contribute more to the program, and others there are more distributions. But over the long haul, assuming that we all continue to commit regularly to each of the private markets programs, it should eventually become self-funding, and the money that's thrown off by maturing funds and distributions then funds new commitments. Taking a look at page 37, you can see the private markets, private real estate funds by vintage year, and you can see that performance has been quite strong for this program, with the exception of the 2014 vintage year. All of the program IRRs for each year are either very close or exceeding the benchmark IRR. And then on page 40, you can see individual fund returns relative to benchmarks. In recent years, you have several funds that are doing quite well. Of course, in a program that's diversified, there will always be some funds that are lagging others. You can also see vintage year diversification on page 41 and geographic diversification on page 42. Most of the real estate program exposure is in North America. At the end of the report, as usual, we have a variety of slides on the market environment, which was strong during the third quarter, and we should see that again during the fourth quarter report for 2019 also. So I'm happy to take any questions on the third quarter private markets report.
All right, if there's no questions, doesn't look like there's any questions right now. So we can go ahead and jump to the next item, the fourth quarter performance report for the pension fund.
Perfect. Okay, so just to give a brief update on market environment, we have the first section here beginning on page 3, dealing with the market, the world markets update. So if you take a look at page 4, you can see the market environment during the fourth quarter of 2019, and you can see that the riskiest assets did the best. And that was really the story for the full year of 2019. If you take a look at page 5, you can see that the S&P 500 was up 31.5% for the one-year period for the full year of 2019. You know, we saw a few rate cuts, which of course have continued so far this year, given the coronavirus outbreak and the action by global central banks. But you can see here double-digit returns for many asset classes, and even Bloomberg Barclays aggregate bonds, so just investment grade, relatively conservative fixed income. That asset class was up 9% for the year. So really strong returns across the board. If we look at the year-to-date period so far in 2020, I know that Prabhu gave you an update on recent fund returns at the beginning of the meeting. But if you look at 2020 year-to-date, we see that the S&P 500 is down 2.8%. International developed stocks are down 8.5%. Emerging markets actually have performed better, which is perhaps a bit counterintuitive given that China is an emerging market. Emerging market stocks were down 6.8%. And then if we look at bonds, as you would expect, they've been quite strong year to date. The Barclays aggregate index is up 4.4% thus far this year, and Barclays TIPS are up 4.5%. Much of the positive performance has come in the month-to-date period in March so far. Of course, we all see the global headlines of markets jumping around, up a historic amount one day and down a historic amount the next day. But thus far, in the first 4 days of March through yesterday, the S&P 500 was up almost 6%, and most major asset classes were quite positive for March thus far. We do put out regular market memos. We put out 3 on the coronavirus so far. We had a webcast yesterday. If you are not on our distribution list to receive market updates, please let me know or let Prabhu know, and he can give you contact information so I can make sure that you're added. Throughout the rest of the report, we have the standard types of exhibits. We have the manager summary on page 20, where we talk about different personnel changes and organizational updates at each of the individual investment managers. And we also have the watch list, which we do quarterly. According to the investment policy statement, any manager that has 3 or 5 year underperformance versus their benchmark is on the watch list, and you can see that on page 21. Getting into total fund performance specifically, I can skip to page 25. And you can see that the current fund value as of the end of December was $3.8 billion. You can see that the current allocations were quite close to the policy targets. And as your CIO mentioned, we will be reevaluating those policy targets and doing asset allocation analysis at the next few meetings. If you look at page 26, you get into performance. Performance was quite strong. As I mentioned, global markets were up quite a bit during the year. For the fourth quarter of 2019, the fund was up almost 5%, 4.8%. If you look at the trailing 1 year period for the full year of 2019, the fund was up almost 14% and outperformed its policy benchmark. And we see quite strong returns for a lot of asset classes. Global equity in particular was up over 30%. And if we look at page 27, one thing I'd point out is that private markets were up over 15% as well. If you look at private equity, it was up 23.2 relative to 7.8 for the benchmark. A major reason for that is that you keep your dry powder for private equity in the Russell 3000 index, and global equity was up so strongly during the year. If we look at page 28, you can even see that some, perhaps less risky asset classes in fixed income, like emerging market debt, was up almost 15%, outperforming its benchmark. And the zero beta, which is designed to be very conservative and really helped quite a bit with the returns recently with the coronavirus scare, zero beta was also positive and outperformed its benchmark during the quarter and the year. If we take a look at individual manager performance, that starts on page 30. One thing that I'd point out is that global growth and U.S. growth stocks have significantly outperformed value stocks, really over most trailing time periods. If we look at the trailing 1 year period, growth stocks are up almost 3 times value stocks, and that really holds true for even the trailing 1 year period, the trailing 3 year period. So that you can see through Artisan Global Value on page 30 and Artisan Global Opportunities, which is a growth manager, on page 31. you can see that both managers outperformed their benchmark for the year. Artisan Global Value, however, was up 25.7%, and Artisan Global Opportunities was up over 10% more than that, and ranked in the top decile of their peer group for the one-year period. Overall, as has been the case recently, most of the portfolio's active managers have posted quite strong returns, both recently and since inception, and within their peer groups. So I'm happy to take a look at any managers in particular, but in the interest of time, I wanted to skip ahead to, let me see here, to slides 54 through 56. These slides focus less on returns and more on risk. So if you take a look at page 54, you can see that the annualized return for the one-year period, and this holds true on the next slides for 3 years and 5 years as well, the returns have been lower than the peer group because there is a lot less equity exposure. However, the standard deviation in the second bar has also been quite low relative to the peer group. So there's been lower returns, but also lower volatility. And that means that in the third bar here, the risk-adjusted return, or the Sharpe ratio, for the 1, 3, and 5-year periods has matched that of the peer group median. So returns have been lower, but so has risk. So risk-adjusted returns have fallen right around the middle of the peer group. We have a variety of other slides, as we typically do, and I'm happy to answer questions on any of them, but want to make sure that I'm respectful of your time.
Go ahead. If I may ask a question, Laura. On page 26, if I look at the overall public equity performance of 24.3 and compare that with the MSCI All Country World Index of 26.4, what would explain the difference, I guess? Is it our allocation? I guess we have higher emerging markets.
Yes, exactly. There are differences in terms of implementation. It's not just through an index fund. So if you take a look at the underlying public equity managers, there is global equity in there, which was up 30.4%. There's U.S. equity, which was up 29.6%. International at 23.6%, and emerging markets, as you mentioned, up 16.7%. Emerging markets look relatively undervalued relative to history, but that said, they have not performed nearly as well recently as U.S. equities.
Okay, thank you.
Trustee Manning, I can also add that our benchmark is not equity, so it's a blend of U.S. and international and emerging markets. Relative to the equity benchmark, we have an overweight to emerging markets, which lagged the U.S. market during 2019 period. That's the contribution to return.
I apologize. I think that was Trustee Sun asking a question, but if somebody closer to a microphone or the phone might be able to repeat that, I'd appreciate it.
Yes, hi, this is Roberto, as if you didn't know. So yeah, that was actually Christina, one of our investment officers in charge of equities, providing further explanation for
I'm
Trustee
sorry, that's
Mason.
Christina. Thank you, Christina.
Yes, no worries.
Any other questions on the pension plan?
May I ask a question?
Yeah, go ahead.
Thank you, Mr. Chairman. Hi, Laura. Harvey Lederman. Could you toggle between slide 49 and 50? Just want to ask you one question if I'm coming to the right conclusion on behalf of the board. 49 is the one-year attribution effects, and 50 is the 3-year attribution effects. Just for the top, I'll wait till we get that up on the screen. 49 and 50. We're getting there. Here we go. And 49, just looking at the total fund. Attribution effects, allocation effect, and selection effect, and then comparing that with over 3 years on slide 50.
Uh-huh.
Can we conclude from that we're getting better at allocation and selecting managers? Or would that be?
I mean, I think it's always difficult to look at a short-term period. You know, we have such different market environments year to year. From Makita's perspective, I do think that your improved governance model with your staff having authority for manager selection means that things can happen more quickly, that your talented investment officers are able to select managers that, you know, they think are best without worrying about, you know, outside stakeholder influences. So, you know, you obviously have a chief investment officer who's now been in place for some time, and I think we have good working relationships with, you know, the consulting teams and advisors. So I would say that I think you're in a very good place, and things have improved. But that said, it's always hard to look at short-term performance and make major conclusions.
Thank you.
May I add, that was a fantastic question, Harvey, and a great
was hoping for a
great
simple
conclusion
yes.
that you came.
Thank you, Mr. Chairman.
Yeah, no problem. Any other questions? All right, Laura, I don't think there's any more questions on the on the pension plan. Go ahead and go to the healthcare whenever you're ready.
Okay, sounds great. So I will just skip ahead to page 20 in the Healthcare Trust Report. So the current total balance is $169 million. The current allocations are quite close to policy, as you can see. And performance has been very strong relative to other health trusts. As you know, the healthcare trust is designed to try to reach the same expected return as the pension trust. That is a bit of a contrast to some of the other healthcare trusts in the peer group because many are more bond-like, more conservative. So if you look at the peer relative returns on page 21, the healthcare trust was in the top 4th percentile of the peer group with a return of 5.5% for the quarter and a return of almost 17% for the year. So the underlying managers, as you know, in this program are the same as the ones in the pension trust, excluding any illiquid investments. So if you take a look, it's mostly implemented through index funds. So returns are very close to benchmarks for the underlying asset classes. You can see the individual managers on starting on page 23. As I mentioned, most of the implementation is through index funds, given liquidity needs. We do have some on page 24 core real estate in the program, which was up over 20% for the 1-year period. We have the same watch list in this fund, which none of the managers are on watch because of performance, and the same sorts of other exhibits as well. I'm happy to take any questions.
Doesn't look like there's any questions for you for the healthcare plan. So thank you, Laura, for your presentations. At this time, there's no other questions, and thanks for joining us on the call.
Thank you very much.
All right, so we're going to go ahead and jump back to 2B, the education session on ESG. I'll turn over to Prabhu for introductions.
Thank you, Mr. Chairman. As the panelists make their way up, a couple of comments. Last fall, the city had passed an emergency climate resolution and had asked the board specifically to take a look at our fossil fuel exposure. And at the time, I had actually provided the board our fossil fuel exposure and had also promised ESG education this year. And to that end, we have actually some distinguished speakers here. I'm just going to run through their bios real quick. Of course, we did do an education session with the IC last year, and now this is to the full board, for both boards. So in no particular order, I'm going to read out their bios real quick. We have Andrew Collins here from San Francisco Employee Retirement System. He's the Director of ESG Investing at SFIRS. And Andrew earned a BS in Environmental Engineering from Yale and has over 10 years of ESG experience. And prior to SFIRS, he was at State Street Global Advisors in San Francisco, where he served as their ESG expert. And he also spent 5 years at the Sustainable Accounting Standards Board, or SASB, where he helped develop the ESG accounting standards for public corporations. And we also have Ophir Bruck here, and Ophir is a relationship manager for UNPRI, Principles for Responsible Investment, the world's leading proponent of responsible investment. And Ophir leads PRI's network and initiatives in North America. And prior to joining PRI, Ophir was at the University of California Office of the CIO. We have Verity Shegar here, and Verity is Director of ESG Integration within BlackRock. And previously, she was an ESG strategist within the BlackRock Investment Stewardship team. And prior to BlackRock, she joined BlackRock in 2015, and prior to that, she was at Allianz Global Investors as an ESG analyst. And she's also currently the vice chair of the Sustainability Accounting Standards Board. Last but not the least, we have Sarah Bernstein, PhD. Sarah is a seasoned institutional investment consultant and has focused on ESG and sustainability issues for nearly 2 decades. And she's currently with Makita as a result of the PCA Makita Alliance. And she has senior responsibilities within Makita on ESG, and as part of the ESG Investment Committee, she is also a member of the SASB. So without further ado, I'm going to turn this over to the panel. Each panelist will speak for about 15 or so minutes, and then we'll have time for Q&A. And again, I want to thank Ophir for actually putting together this panel. Thank you.
It's a pleasure to be here. Hi, everyone. Thanks for having us in today. We're gonna each touch on a piece and hopefully create a kind of put the puzzle together for you and answer questions at the end. So I'll start. You've received my bio, so I'll just jump right in. And just to clarify, I oversee the Western North America region of the PRI. We're headquartered in London, and we've got a team here in the U.S. So I am going to start with some definitions for us, to kind of get everyone on the same page, know what we're talking about and what we're not talking about. And so starting with a very broad definition of responsible investment. It's in our name, the Principles for Responsible Investment. So very broadly speaking, responsible investment it's simply a strategy and practice of incorporating environmental, social, and corporate governance issues or factors into investment decision-making and into what we'd refer to as active ownership decisions, also known as stewardship, how you are voting and engaging with companies in your portfolio. This is a broad umbrella term under which there are other approaches and definitions. So you might have heard some other acronyms like SRI or ESG or impact investing even. So all those would fall under this broader umbrella of responsible investment. And I'll cover some of those approaches that I just mentioned in just a moment. Interesting. So we're really beginning with the premise that environmental and social and governance issues affect the risk and return of investments. So kind of zooming out to the macro level, this here is the World Economic Forum's 2019 Global Risks Report, which identifies the top risks globally in terms of both impact and likelihood. And you'll see here, if you can read this, that the list is very much dominated by environmental and social issues. And most of these, actually, extreme weather events, water crises, biodiversity loss, large-scale migration, all of these can actually be tied to a broader issue of climate change in some form or another. And if we zoom into the company level, I'm sure you're familiar with many of these names here. at the company level, we see environmental, social, and governance risks playing out in value-destroying events all the time. Each one of these companies just listed here has felt the very real impacts of a major ESG issue or event over the past decade. In our state of California, I think PG&E is a great example of where the issue of climate change has led to some issues. And so that's on the risk side. On the opportunity side, we live in a changing world, and understanding how that world is changing and the environmental and social trends that are driving that change is critical to identifying opportunities on a forward-looking basis. And so one example, this chart here shows the International Energy Agency's annual predictions for solar voltaic uptake year on year, showed by the colored lines, whereas the black line shows what actually happened. And so even international agencies can miss trends, is the point here. And the key message really is that as an allocator, as an asset owner, it's critical that you have a clear understanding of how your managers are equipped to identify both the risks and the opportunities associated with environmental and social and corporate governance factors in a changing world. So here you've got a list of a few out of hundreds of ESG issues that can potentially impact the risk and return characteristics of an investment. And again, the key here is to understanding which environmental factors, which social factors, which governance factors actually have a financial and material impact on a given sector, industry, or company. And there's a lot of work being done to really understand what those factors are so that an investor can incorporate that data into their investment analysis. You'll hear a little bit more about that from my fellow panelists. And so when we think about how is responsible investment done, there are various approaches, and I mentioned some of these different approaches or definitions earlier. So I'd like to quickly run through these so we're on the same page here. You've probably heard of socially responsible investing. This tends to refer to either negative or positive screening out of objectionable companies or sectors, sin stocks. It's kind of the genesis, if you will, what's been practiced by faith-based investors decades ago, and since then the practice has evolved as more data has become available. And next on this list here, you'll see ESG integration. And what we mean by ESG integration is the proactive incorporation of environmental, social, and corporate governance criteria into financial analysis for the purpose of identifying risks and opportunities that drive, during the investment process, that drive risk and return. So that's ESG integration, and really that's the core of what the PRI focuses on and supports our signatories with, is how to integrate those ESG, financial material ESG factors into the investment process to identify risk, to manage risks, and to generate sustainable long-term returns. Next on that list, you'll see stewardship. Stewardship is referring to, again, the practice of shareholder engagement, also bondholder engagement, as well as voting your proxies. So this is how you're engaging with the entities in your portfolio to influence their practices, their management of sustainability-related risks and opportunities. And finally, impact investing. And this is really the practice of allocating to investments with a very intentional goal of delivering measurable positive social and or environmental impact. And this can be done alongside financial return at market rates, or this can also be more concessionary impact investing or an impact-first lens. So moving along, if the iPad decides to comply. So there are many drivers that are driving why responsible investment has become so mainstream, why you're hearing about ESG when you go to a conference, and why institutional investors are really systematically embracing these approaches to investing. One of them is materiality. This is something we just discussed, the idea that or the reality that environmental and social issues can affect risk and return. The second is market demand. So this can include the changing investment preferences of the millennial generation. This can also include the desire for pension beneficiaries to understand how their capital is being invested and how their pension fund is addressing issues like climate change. And finally, it's allocators and asset owners really prioritizing responsible investment, incorporating these factors into their RFPs, into their manager mandates. On the regulatory and policy front, we're seeing an exponential growth in policies and regulations that are either mandating or encouraging investors to incorporate these factors into their investment decision-making. A few examples in the US, in Illinois, we've seen the state adopt the Sustainable Investing Act. This mandates all public funds in the state to adopt ESG policies. In the state of California, there is SB 825, which mandates California domiciled companies to have at least one female board director on their board. Just two examples of many. And finally, academic and industry research. We're seeing a growing body of research that's really making clear the relationship between environmental, social, and governance factors and financial performance. I don't have time to delve into these studies now, but certainly can send any of those to you there, following this presentation. So I'm going to skip ahead a little bit here and jump into who the PRI is and how what the PRI does to support the institutional investment community with responsible investment. So back in 2006, then UN Secretary General Kofi Annan gathered a group of institutional investors at the UN and begun a process of developing a set of principles that guide responsible investment practice. These 6 principles were developed in 2006 and officially launched at the New York Stock Exchange in April 2006. Since 2006, that group of 70 founding signatories has grown to today a network of just under 3,000 asset owners, investment managers, and service providers across 60 countries that collectively represent 90 trillion. So over half of the world's institutionally managed assets have committed to implementing the 6 principles. What are the 6 principles? Here they are up on screen. You'll see the 6 principles there, and then you'll see our mission statement above that. And you'll see that our mission statement takes a broader look at the financial system as a whole, and the PRI is really working to achieve a sustainable global financial system by fostering good governance, integrity, and accountability, and by really working to promote the principles throughout the investment industry. And so the 6 principles, without spending too much time on each one, really focus on incorporating ESG issues into the investment process, being active owners, as we mentioned, engaging with companies, driving meaningful ESG data through markets, so really making sure that the necessary data is at the hands of investors to make informed investment decisions. And then 4 and 5 really focus on promoting the principles and collaborating with peers. The PRI is very much a collaborative network. And then finally, principle 6 is about reporting. So our signatories and becoming signatories commit to annual reporting on their implementation, with the first year being a grace period. So this here is a breakdown of our global signatory base. In the US, our PRI signatories include Los Angeles City, Seattle City, San Francisco City and County, as well as county and state pension plans throughout the country. And really the PRI is set up to support our signatories with understanding how to develop the policies and translate those policies into the manager selection, appointment, and monitoring process, really guiding allocators on how do you integrate ESG factors into your manager mandates and ongoing monitoring of your managers. So some of the ways we do that, and sorry, this This iPad's being a little glitchy. But generally speaking, we have things like due diligence questionnaires. So this is a list of kind of off-the-shelf ESG DDQs that can be incorporated into the manager selection process. And I mentioned that our signatories report to us on an annual basis. So what this does is puts that data in the hands of you as an allocator to know how your managers in your portfolio are incorporating the 6 principles, what their policies and practices are, what systems do they have to operationalize ESG integration in their investment process. And so this is just an example of some of the guidance resources that the PRI makes available to asset owners, guidance on crafting an investment strategy, and investment policy that incorporates ESG, and even how to engage with your investment consultants on ESG factors. So with that, the rest of the slide deck talks more about the various guides, resources, tools that we make available to our signatories. I'll let you peruse those on your own time, and I will, for now, stop there, hand it over, and we can answer questions at the end. Or if you'd like, I'm happy to pause and answer any questions.
Let's just go ahead and go through the
Yeah,
presentations.
sounds
We'll
good.
get the questions at the end.
So here is SFRs.
Great. Thanks, Ophir. And yeah, thanks for having me in this morning. So as Prabhu introduced me, I'm the Director of ESG Investing for the San Francisco Pension Fund. Really here just to talk about our journey integrating ESG factors into our investment process, building out a program. We'll walk through sort of what we've thought about, how we've evolved over time, but on an ongoing basis, I'm happy to be a resource to you all. I've drawn on, in addition to Ophir at PRI, peers at other plans around the state and country, and as we've thought about these issues, what's right for us as a plan. So to just sort of set the stage a little bit, this is a little bit about the San Francisco plan. We manage about $27 billion. We have a 7-person retirement board. But really, what I think is always really important to call back to and benchmark to is our mission, which is the same as your mission, which is to protect and secure assets, act as a fiduciary, and ensure that you're paying retirement benefits every month to the beneficiaries. This is really important for us as we ground our ESG program, that all the actions we take around environmental, social, and governance issues, which I think can be perceived as socially motivated or concessionary in nature, and they can in some manifestations. All the things that we do and the way that we make decisions about it, has to contribute ultimately to this mission, and not just sort of not have a negative effect on our mission and our goals, but actually contribute positively to the way that we're enhancing our performance and ensuring that we're paying out our benefits. So, first and foremost, we are fiduciaries. Our board is fiduciaries. Anything we do related to ESG has to be grounded in that, be called back to that. Second, like you all, we're an allocator. So I think there's, sometimes misperceptions around ESG that it's related to, picking certain stocks over another, or being really in the weeds in terms of, fundamental analysis of, particular companies or industries. But us as an allocator, we have to think about what are the actions we take around ESG in terms of the way that we're selecting managers, and where our control begins and ends around different ESG issues and topics. And then lastly, we're a diversified investor like you all too. The way that ESG issues matter in different asset classes does really change, and I think we have to sort of right-size our approach depending if we're looking at our public equity portfolio versus our real estate portfolio versus our private credit portfolio, and know what we can expect our managers to be doing and thinking about these issues, and not expect too much or expect too little, depending on the investment approach. So as Ophir outlined really, really well. There's a ton of things that can fit within the ESG umbrella, a ton of different ways you can tackle this and approach this. The way that SFRS has done this is we've come up with an ESG platform that has 3 different pillars to it. And I'll get into those pillars. A lot of this stuff is sort of overlapping, but that's helped us organize our platform. And one of the first things that I did when I joined was help, outline this strategy and set up these 3 pillars, so we know sort of what we're thinking about in terms of our ESG approach. Again, this is meant to contribute to our mission, and we want to take actions around ESG that materially are value added to our mission. So we don't want to be swayed by political or social agendas that do or can be associated with some of the things you think about in terms of human rights and climate change and the various topics that do fit under that ESG umbrella. Our journey on this actually, we've done a lot in the last few years, but it began about 30 years ago when we first had our social investment procedures. And when Ophir was talking about those different approaches to ESG and this sort of socially responsible investing approach, that's sort of what initially the San Francisco plan had in place. We called it our social investment policies. And a lot of the actions that we took really, over the first 25 years or so of our program were about identifying certain industries that we didn't want to invest in, like tobacco, companies that were in Sudan, thermal coal companies. So it was, motivated by risk. We said, these certain sectors have outsized risks associated with them. The tobacco restriction went in place when the master settlement was occurring, and we thought the tobacco industry was going to, go under, at least domestically. So it was, the sort of first step, but in some ways, I think a pretty crude approach to applying these principles, because it was just sort of began and ended with cutting out sectors from our investment universe. As we've developed our program over the last few years, we've approached this more from that risk and return perspective that Ophir was discussing, in terms of how do we actually think about ESG issues in a way that can materially affect any type of investment we make, not just in certain sectors, which is why we've really shifted our language and thinking from social investment procedures to now our ESG policies and procedures. And we've put in place an ESG strategy, and this outlines a lot of the actions that we've done in the last few years. We've adopted specific strategies around climate risk management, thinking about our oil and gas exposures, as we've taken or faced calls for divestment of our oil and gas exposures. We've tried to conduct analysis and risk-based analysis to really think hard, where do we see risk, as well as continued opportunity in the oil and gas sector. We've joined initiatives like the 30% Coalition, which is advocating for more women on corporate boards. We've joined global initiatives like Climate Action 100 and the Ceres Carbon Asset Risk Group, which are investor coalitions that really help us amplify our engagement efforts that Ophir was talking about in terms of engaging with underlying companies. And then I think most importantly perhaps is we've begun to integrate ESG issues into our manager selection and due diligence process. So in 2018, we started this really focused and said, we'll start with public equity and some of our private equity managers. Throughout 2019, we expanded this across the portfolio. And then through 2020, we can really say that every time we bring a manager recommendation to our board, we've considered ESG factors and how they think about ESG factors, and included that in our memo to our board, and they now expect to see that, at least how we've done due diligence and thought about that. So these are those 3 sort of pillars that I mentioned that form our strategy. The first is really these active ownership activities around engaging with underlying portfolio companies in publicly traded companies. We do a lot of this through coalitions. Resources are constrained for us, so really to be effective and to be able to do this at all, we have to join with other institutional investors and do it through coalition. It also includes our proxy voting policies. So we've tried to revamp those and really plant a stake in the ground around what corporate governance issues we think are important in our public portfolios, implement strong proxy voting policies with our proxy voting advisor, Glass Lewis. The second pillar are those manager selection and due diligence screenings. We've pulled on a lot of the resources that PRI has around those DDQs Ophir mentioned, and we now have tailored due diligence questionnaires for each asset class around ESG. We're not expecting, right, any sort of, we don't have expectations or requirements for our managers around ESG, but a lot of it right now is just fact-finding, asking them where they're at, how they're thinking about these issues. We're not requiring ESG or green investment strategies per se, but really just want to find out, do you think about these issues in your investment process? How do they inform you and make you better investors? And sometimes it's at the margins, sometimes it's really core to the strategy, but it's helpful for us to understand that better. And then the third area is really what we call ESG collaboration and communication. So we found it's more and more important to communicate with our beneficiaries around our ESG policies. So we're trying to do more of that. Communicate with the city government, our board of supervisors in terms of how we're thinking about these issues, but then also communicate to our existing managers, potential managers, through our policies. So we have an ESG policy, as I mentioned. In our investment policy statement, we include reference to ESG practices in there too, to really signal to managers how we think about these issues, what we think is important and where we want them to focus. And then our PRI reporting is a huge part of this too. So we just signed up to PRI 2 years ago, did our first report last year, and it's a really, really helpful tool in terms of us being able to organize this strategy and program. Doing the reporting is a strenuous but good exercise in terms of looking across the whole plan, level setting with our CIO, with all our different investment teams around how they're thinking about ESG issues. So I'm gonna stop there. The rest of the slide deck goes into more detail into each of these pillars. So as you think about that, you can look through that. I'm happy to answer any questions at the end on any of this. But again, thanks for having me in here today. This is you, Sarah. Just give me 1 second.
Sure.
Downloading. Nope. Huh. There we go. Thanks.
What do we do? Just
Sort of swipe it.
There's a bit of a lag. It
is
should pop up in a
okay.
minute.
Wait,
There we go.
let's see. Okay.
that's your
Good
side.
morning. Thank you for having us. I'm Sarah Bernstein with Makita, and I'm going to spend a few minutes just talking about some of our public pension fund U.S. clients and what actions they've taken or engaged in on issues of ESG. And then we spend a couple minutes of highlighting areas where if this board wants to consider discussing further, it might make sense for further discussion. So this page just, where do you implement ESG in a public pension plan portfolio? Andrew's given an excellent example of how they've been working on it in San Francisco. But if you start looking across public pension plans that are doing something, which by the way is not everybody across the country, but as we even find more and more interest at smaller plans and assets under management than we did, say, 10 years ago. But you'll find it across the board through being integrated and thought about throughout. If you have investment beliefs guiding your portfolio, plans are adding and considering putting an ESG-related and sometimes climate-related investment belief, following that up in their investment policy. Even in asset allocation, I would say for the most part, any ESG considerations under actual asset allocation are really within asset classes, not, this is not shifting between what your equity and debt exposure is or how much in private markets versus public at this level. And as was discussed, there's a lot of growing emphasis on integrating material, environmental, and social and governance questions into how your managers are working for you. This is particularly important in active management and is very different across asset classes. Real estate managers are going to face different questions than, and you want to make sure they're paying a different attention to different issues than, say, a public equity small cap manager. But it's also relevant for passive exposures, and for example, in equities. And both Ophir and Andrew spoke to the stewardship and shareholder actions, and the level and degree of what any passive manager, how they're voting their proxies on your behalf is something that's become a question. And does it align with your own proxy voting policy? So both monitoring investment managers and when you're doing a search, incorporating material ESG questions into those searches, into the due diligence process itself. And then to some degree, there's growing monitoring of the overall investment portfolio, both for select ESG factors, but more and more, and some of this is being required. For example, CalPERS and CalSTRS both are now required by the legislature to produce a climate risk report annually, and they're not the only one around the country. The engagement that we've been talking about occurs both as an extension of how you work with and your consultants do work, and your staff with your investment managers. Also in collaboration with other entities and organizations like PRI or Ceres to reach out to regulators and governance on specific issues, and this can be from the SEC to, there's various letters that have gone out by broad sets of institutional investors on concerns on climate, but also on governance and just broad issues that affect institutional investing. And then company-level engagements with companies that are actually you're invested in through one of your managers. Before we move on to some of the examples, I want to stop this general page with the point that the costs of how do you implement this vary widely across the board. So from minimal to adding staff and time and resources. So it's not something you just say, oh yes, we want to do all of this without thinking about how it fits with what your mandate is and also your staff and consulting resources. And I don't know if Andrew got a chance to mention it, but they're a good example. They've been very active for a number of years, and now I believe have 2 full-time staff on really focusing on integrating environmental and social governance issues into their portfolio. On the next page, this just, and I'm not going to go through all of these, but if you start, these are organized by larger public pension funds at the top to start with, and these clearly have different resources than your plan would have, and have some of these been doing these for over, into 2 decades. But CalPERS, for example, is one of the co-founders of PRA and a number of other global organizations, including just last fall, there was the Net Zero Asset Owners Alliance launched, which is setting out a goal of getting their portfolios by 2050 to be sustainable in the sense of being aligned with a net zero in terms of net zero carbon emissions, greenhouse gas emissions, sorry. CalSTRS has been very active also, and I'm just pointing out a few bullets for each of these funds. I could spend an hour talking about each one, but some highlights for CalSTRS have been they launched a lead organization in engagements on civilian firearms, have been a founding investor and lead investor in ESG passive indexes, such as one focusing on women in boards and a separate low carbon passive index, and have been active across the board and for years, sometimes profitably, sometimes early stages, and recognizing some losses on their green tech funds in the private markets. New York Common Retirement Fund has a new policy as of last year, as of 2019. They put together their own climate board and came up with, the advisory board came up with their climate action plan. And one of the results of it is they are beginning to monitor their managers and their consultants, all their providers, for alignment with the New York Climate Action Plan. And they're not just asking them questions and how are you going to do this, but they're starting to think about devising metrics and also potentially putting managers on watch for in areas where they think that they're at risk because they're not moving on certain issues. So that's a brand new level in the US at least of really integrating ESG issues into your portfolio assessments and your manager assessments. The UC Regents, this is announced that they want to, this is another action people are taking, this very rare across the US public funds, but there is, have announced that they're going to just get out of fossil fuels. In other words, they're proposing to pursue more of a divestment strategy rather than focusing on the engagements that we've heard about earlier. And then I'm going to go through a smaller one here. For example, Vermont Pension Investment. They're about $4.5 billion now in assets under management, and they have been extremely active on the engagement side with underlying companies, and even though they're a relatively smaller fund, have been co-filers on proxy shareholder proposals to encourage disclosure and transparency on key risk issues, particularly around climate. We have a client, Hawaii, who's fairly new to these issues and is just now working through the process. They've decided to become a PRI member, and we're helping them go through the reporting and effort. It is a lot of effort, but I'm glad to hear it's useful too for a plan to see what you get out of it. So I want to move to the next page, and there's a wide range of areas that you might want to think about if you did want to consider more formally integrating environmental and social and governance practices into your portfolio. The reason to do it would be to further strengthen your overall mission of providing long-term benefits and improving the risk-adjusted returns of the investments that are being made. So I've just listed a few here. If you all have, I'm not sure the plan has formal investment beliefs. If that's something you develop, you might, while you're developing it, want to consider including an ESG-related investment belief. And review on a regular annual basis where your due diligence questions are and what they look like. They are evolving over time. 5 years ago, some of the basic questions that were ESG related for managers were, are you a member of PRI? Are you a signatory? Now the questionnaires have really evolved to look at, okay, yes, you say you're integrating material ESG into your portfolio analysis. What are the results? What have you found? Has it had an impact? So getting a little further into how folks are really integrating ESG issues and whether it matters or not, and if so, give examples. And you could consider expanding your engagement with both your managers, which can begin by just follow-up questions with your managers. Say if you have an annual report from them on ESG questions, if there's something that stands out that you want to follow up and ask them why their results were the way they were. There's multiple efforts and opportunities to become signatories or sign a letter that's being coordinated by broader groups to various regulatory and government bodies. Company engagements is, I would say, a much more cost and resource intensive, not doable, but it's certainly you need to think it through and think how you would do that if that was something that you really wanted to pursue. And then, as I mentioned, at this point, discrete portfolio monitoring on particular critical issues, material issues, is something you might want to consider, or climate-related risk monitoring. So I'm going to really stop there and turn it over to Verity from BlackRock to give you some insights from a large manager that's very active in this field. Thanks.
Are you able to hear me okay with this microphone? Or
There,
shall I?
switch.
Okay, thank you.
There you go.
Thanks, Ophir. Is that a little bit better? Yeah, okay, great, thank you. Thanks very much for having me here today. As Prabhu mentioned, I'm with BlackRock, and I've got 17 years of experience in the investment industry. About half of that was in U.S. equity portfolio management, and the more recent half is focusing on sustainable investing. And my goal here in speaking to you today is to give you one example of what an asset manager is doing in terms of integrating ESG into our investment activities, in order to hopefully inform you of what you can expect, but also understand the reasons why we're doing this. And hopefully that will inform the way you manage the pension plan and future allocations and questions for your managers. So BlackRock's CEO and chairman, Larry Fink, writes a letter to CEOs every year. And in his letter to CEOs this year in January, he really underscored this idea that we are seeing a significant reallocation of capital. This is related to the manifestation and the realization in the markets that sustainability information is translating into asset prices. Specifically, climate risk is now very clearly investment risk. And this idea is underscoring the fact that it does not matter what state you're in or what your who you voted for, but it is affecting the asset prices in your portfolio, and therefore it is worthy of attention. What's underlying this is a number of factors. So we're seeing massive investor adoption, not least from public pensions, but also insurance firms who are really getting more granular in accounting for things like climate risk, putting a number on it, understanding the relationship between 1 and 100-year risks now showing up every 18 or every 2 years. We're also seeing a shift of wealth from older generations to the younger generation, where they have a very strong preference for allocating capital towards sustainable investments and portfolios. There's also a rapid acknowledgement of the risks presented in climate change. And this is leading to not only technological advances and innovations, but also regulatory pushes that are really sort of meant requiring that this information become better understood and more transparent. And together, these trends that we're seeing are leading to this reallocation of capital, which is truly establishing a sustainable risk premia in the markets that we don't think is yet priced in. In other words, if you are looking at the sustainability attributes of the investments across your portfolio, we want to know what are the issues, the ESG issues that could support long-term economic growth and returns in your portfolio, or what are the issues that might not be well managed, well accounted for, and well disclosed that might blow up in your portfolio and cause negative performance. It's important to remember, as my panelists have been mentioning, that what we're talking about is still investing. So you've heard a lot of jargon, you've heard a lot of definitions, and you've heard a lot of acronyms already, but we're still talking about investing. And investors take a lot of information that's available in the public domain. They take market signals, pricing information, financial accounting information, and we're suggesting now there's an imperative to include and look at environmental, social, and governance information, which is increasingly affecting asset prices. So ESG is information. When we're talking about integrating, we're talking about including ESG in the total mix of information that you would consider when making an investment decision. And that's precisely what we're doing at BlackRock across portfolios. So ESG information is relevant in analysis, portfolio construction, and portfolio review steps. And part of that is understanding how ESG is risk and accounting for that. That's why we work really closely with BlackRock's risk and quantitative analysis team. That's the team that sits outside of our investment teams, but provides this very important check and balance to understand, is the portfolio achieving its objectives? Is it invested aligned with its rules for investment? And are there unintended consequences or outsized risks that are manifest in the portfolio, including ones related to some of these E, S, and G issues? In this way, ESG can be a proxy for quality, and it can also be a proxy for risk. So how are we doing that? I've included here 4 examples from fixed income, active equities, our cash team, and the private equity business of alternatives. But in truth, we are doing this at BlackRock, this ESG integration work across all of our investment divisions. We have 7 investment divisions, about 150 investment teams, including in our index business, through which the mechanism for ESG integration is this active investment stewardship, that practice of engaging portfolio companies owned by our clients, but encouraging them to disclose the material ESG information that helps investors in the general public understand the risks and then accurately price them. So here you can see 4 snapshots of how ESG information is pulled into our investment tools and research templates. The important thing to recognize here is that this is sitting right alongside the financial information that our investors use to make investment decisions. So this inclusion of ESG information alongside financial information in order to come up with valuation, understand if an asset is appropriately priced or mispriced, and there might be an opportunity or a risk premium associated with that particular investment option, and therefore upside potential. So we're practicing this. It looks different in each asset class. It looks different across different teams, and that's important because we want this to be something that is actually adoptable and usable and applicable to the specific asset class and style of investing. The common thread you should have noticed across those examples is that at BlackRock, investors are responsible for ESG integration. So although my title is director and I sit on the BlackRock Sustainable Investing team, I focus on ESG integration at BlackRock. I'm not the one who's saying this is good, this is bad, this has ESG risk, this does not. It's the investment professionals who take in information, who are also the people responsible for looking at the relevant ESG information and deciding, does this change my view about the upside or downside potential of a given investment, and then integrating that into her own investment decision and portfolio allocation. It is worth mentioning that we do have top-level support, not only from our CEO and chairman, but including from the Global Executive Committee. There's a body that sits within that group of management leadership called the Investment Subcommittee. It's really important that that group, which oversees investment process for every team at BlackRock, also oversees this ESG integration. So it's fully integrated into the oversight and risk controls and governance of our own investment organization. The BlackRock Sustainable Investing Team coordinates these activities and makes sure that we have a consistent approach, not only for definitions internally, but also that we're all working toward the same goal, which is to do ESG integration in a consistent and credible way. So we set standards, and we help teams achieve those standards through coordination. We also do an annual assessment of teams at BlackRock. As I mentioned, we have more than 150 teams. And we learn through this process which teams are struggling, often for a reason that is not unique to BlackRock, but it's an issue that the whole market faces. For example, in a U.S. Treasury bond portfolio, how can you use ESG to distinguish between a 2-year Treasury and a 10-year Treasury bond? That's something that I think PRI would be great to help us sort of understand and get at that granular level of understanding and application. But we also understand through this process of evaluating our own teams who is doing a really great job, who has really done something innovative in a tool. Often that's a knowledge that can be shared across our own teams for the benefit of the whole organization. One thing we're doing at BlackRock is making sure that we are doing a more proactive effort to describe externally what we're doing in terms of ESG integration. And here you can see a snapshot of the PRI reporting we have done and the assessment scores that PRI has given our reporting. So we have been a signatory to the PRI since 2008, and in line with our obligations to uphold all the 6 principles, we do annual reporting. And you may notice here that each year we've done an effort to talk about our practice of ESG integration across more of our asset classes, including in the funds we manage in-house, as well as the advisory funds we allocate to general partners and other external funds. We've also are very pleased to have improved our scores through better learning, deeper connection, knowledge sharing internally, as well as innovation that's happening across the market. You see here the scores that we're very proud to share are at or above median in practice. It's important to know the limitations. So if you were to use a PRI scorecard of a manager in order to assess the quality or sophistication of ESG integration across a manager, you should know, for example, that the reporting framework is broken up by asset class. So you see here securitized fixed income and property and listed equity and corporation are 3 different lines. However, we might have a multi-asset strategies portfolio which combines our activities across equity and fixed income. And so you still will benefit from that conversation at the investment portfolio team level that Andrew described, asking your other managers, how do you incorporate ESG into the fund, and how does it influence investment decisions? As our own practice to disclose has improved and expanded, we are noticing also an expansion in the ESG information available for us to analyze and incorporate. There was an issue of a company disclosing sustainability data at all, but now more than 85% of the S&P 500 are reporting some kind of sustainability information, including many Silicon Valley companies. The problem is it's not always decision useful. It's not always material. It's not always related to the core business, or in other words, it may not change an investor's view about the risk or opportunity of investing in that particular company. And so what has happened is investors have gone where useful information resides. We've used unstructured sources of data, Glass Lewis, EPA databases, satellite imagery to get the kind of decision useful information that can help us understand ESG risks from non-traditional sources. And there's also been a proliferation of third-party research providers. So just as there's a sell-side infrastructure willing to give you an opinion of whether you should buy, hold, sell a stock, there's now a whole body of research providers telling you if something is ESG good or bad, strong or weak. Okay.
Yeah, it's a bit glitchy. I think it's an iPad 2.
Well, I'm on the page. Here we are. Because of this proliferation, we've gone from a scarcity to a proliferation of ESG information. However, we still need to get to this place of investor-grade ESG information. Ophir mentioned a few examples of sort of ESG incidents, which are really sort of defining the materiality case of sustainability aspects of corporate performance. And you all will remember Enron, and that disaster led to a very strong regulatory response, which led to very strong transparency. We are not seeing that same level of regulatory requirement, the way that has underscored financial reporting, financial accounting over the last decades, as required and enforced by securities regulators. So in the meantime, what is happening is a market response. And this market response is coming from both investors and companies saying, we recognize these issues are material. We need a standard way to disclose them. At the same time, investors are saying we need standardized reporting, and we need this information at the same level of quality that we get the financial information. So BlackRock is heavily involved in two organizations mentioned here, the Task Force on Climate-Related Financial Disclosures, and also the Sustainability Accounting Standards Board. And the differences and the commonalities are listed here. But I think what the takeaway for you here is that as the data continues to improve, we expect to be able to provide more granular attribution and also more efficient pricing of the sustainability risk premia that is clearly in the market today. And I'll leave it there.
Well, thank you, everybody, for the presentation. We'll just go ahead and open up for discussion if anybody has any question. Eswar?
Yeah. So question for Andrew. So San Francisco has been doing this for a while. Have you seen what the impact on performance is over the long term?
Yeah, great question, and certainly something we're trying to figure out better. Very specifically, we can measure performance for our investment exclusions. So we've gone back and historically looked at that. Everything, well, I'll say our tobacco, the decision to exclude tobacco from our investment universe on an aggregate basis was negative to the plan's returns. All the other investment exclusions we've done very marginally contributed positively to returns. Other than that, I think the program, in earnest, really in detail kicked off a couple years ago. We're trying to figure out ways to better measure performance. As Verity said, there's a lot of work now to sort of see, like, can ESG be measured as a risk factor or a risk premia? And I think there's more work to be done to see, how you can actually attribute performance to ESG. But I think we sort of think about it as a function like our risk function that contributes, to our investment process, but still emerging. How do you quantitatively measure its impact?
Yeah. And then do you revisit things? I mean, for example, you can say an oil company, for various reasons, you don't want to invest in, but the oil company may change, right? Because now they're investing in sustainable energy. Do you go revisit these decisions? I mean,
we do. We do. So I present every October to our board, sort of everything ESG. We do that annually. With the oil companies that we've sort of flagged for risk, we do revisit that every year, and we think that there's an ability for companies to change their risk profile from a climate perspective, ESG perspective. So we want to, stay responsive to that. That's part of the other reason that this engagement everybody's been talking about is so important, is institutional investors collectively voicing their view of how corporations can mitigate risk, look towards the future. Really, I think more and more has shown that they can influence the way the corporate decision-making takes place. You want to stay invested with those companies, be a voice, and have a seat at the table. And there's no harm in doing that. It actually can be really, really beneficial if companies do take those steps, address risks, and maybe pivot where necessary to, be a company that's going to be really successful in the future.
Yeah. And one more, if I may ask. I mean, there's a lot of subjectivity to this, especially in the S part of it, the social part of it. I mean, is there data on like the correlation of how people rate the same company, maybe, or the is there wide variation in terms of some people may say this is a great company, and some people may say it's not. I mean, I think China is a great example, second largest economy, and you can make a case that there are a lot of Chinese companies that support repression in the country, and whereas others may say, well, I mean, China's improving. How do you deal with that?
Yeah, I mean, maybe others want to comment on that. You're exactly right. There is a lot of subjectivity. So I think it's really important for you as an investor to define what you think is important. And yeah, there will always be those sort of differing views on a relative basis, different ESG topics, and your approach, right? You may want to be invested with companies that are best in class. You may also want to say, I want to be invested with companies that are improving in their ESG profile.
Yeah.
Yeah.
I would just add to that maybe, and Sarah, then I'll pass it off to you, that one aspect is to answer your question, the importance of standardization, right? So Verity talked a little bit about the Sustainability Accounting Standards Board creating more standardization of what are the ESG factors that are financially material to a company, and then making sure that the company is disclosing against those those metrics. And but once information is at the hands of an investor, ultimately the investor is making, whether it's ESG or not, what they think is an informed investment decision. So I think subjectivity is an inherent part of investing, and is equally applicable to ESG investing. And it's not a bad thing that different ESG ratings or data providers have their own methodologies, and it's just about understanding how they've reached the assessment that they have, and whether you agree with it, as Andrew said.
Yeah, I would just add to that, you're right, there's absolutely judgment involved, and the correlations range. One recent study, I think it was between 44 and 77% correlation at a company level between the different data vendor providers in what ratings they gave to those companies. So one important distinction to make is to look at the data, the actual data, if it's material, rather than the rating somebody's giving you. And as Ophir said, if you do look at them, make sure and understand where they're coming from, how they arrived at that. That's distinct from material as a labor issue material at Google versus I don't know, Volvo. I mean, there can be various different material issues, and that's why I think the SASB work to standardize is really, really helping move the industry forward, but it's a long way to go to get beyond the largest companies reporting in a consistent way.
Maybe one other thing to add, since you brought up social issues, I think just to kind of demystify, yes, there are some issues that fall under the broad category of social that could be subjective or very geographically relevant, but there are social issues that are very clearly financially material. I think human capital management, how a company treats its employees is a perfect example.
Go ahead, Harvey.
Thank you. I'm Harvey Lederman, Fiduciary Counsel to the board. This is a question. We measure our investment performance against benchmarks, and so I'm wondering, Sarah, have you seen any move at all towards ESG-sensitive benchmarks that are available to funds like ours to use instead of the passive benchmarks that we're presently using?
So there is, if you want a benchmark, the benchmark providers will provide it. And there is a range of ESG and climate and low carbon and X carbon and all kinds of variety of benchmarks that are available. I would say that the vast majority are still really looking at their core benchmark as a market cap weighted benchmark, and that these material ESG issues are being looked at to try and enhance that sort of, to meet or beat those benchmarks, not adjust to a different one. That said, there's even Paris-aligned benchmarks that are coming out. In other words, Paris-aligned with on the climate side. So I don't have a one to give this board that they should say absolutely everybody's using this one, and it really makes sense because you can see X, Y, or Z out of it.
Have you seen any institutional investors like ours moving to ESG-sensitive benchmarks? Because if the risks and opportunities are there, shouldn't we be measuring ourselves against those sensitive benchmarks as opposed to the S&P 500 broadly?
I've seen them slivers, not whole portfolio, at least in U.S. public pension funds at this point. Definitely something under consideration, but for the most part, I think.
Verity's going to jump
Yeah.
in, and then I have
Go ahead.
a comment on that.
Yeah.
Thank you. So BlackRock does have a large ETF business, and of course, in order to mirror an index, you need to select an index. And part of our commitment this year is to make sure that we have the right building blocks available for clients so that they can create a total portfolio of all of the exposures that they would normally require. And many of our clients are looking to do that in a total portfolio of index allocations. So we're working very closely to partner with index providers across all of the index family funds to ensure that there are ESG versions of all of the most requested benchmarks that our clients need. And one specific commitment we made is to double our own ESG labeled ETF family to 150 ETFs. So that gives you a sense for if each one of those has to have an ESG benchmark, that gives you a rough number of where we want to go pretty quickly in order to meet this clear and present demand. On the question of other asset owners that are allocating to ESG benchmarks, I believe the largest pension plan in the world, the General Pension Investment Fund of Japan, did just that, and they notified all of their external managers and made it part of their core investment approach to manage their portfolio against ESG benchmarks, recognizing that ESG is what the market is now. It's standard in the market.
And that's really what I was going to speak to is from the PRI's purview, kind of seeing how the market is evolving. We're really seeing the directionality therein, seeing sort of, we've seen allocations to passive ESG indices, but we're starting to see more adoption of ESG benchmarks as the total fund policy benchmark. And we're seeing more of that happening in Europe at the moment, and other jurisdictions. But I think that's the directionality because of exactly the reason you mentioned.
I have a few questions, Andrew.
Oh, go right ahead.
Will you go first if you want?
Oh, I'll wait.
Yeah.
Go ahead.
So my first question is for Andrew. In terms of the team that you have in San Francisco, how large is that? Is it just you, or is it a group of you? I'm just trying to estimate what it takes in terms of staff and in terms of cost.
Sure. Yeah,
Yeah.
it's I'm supported by an analyst, so it's just the two of us. We're on an investment team that's about 24 individuals. So I think, yeah, it really, as I think Sarah mentioned, can really depend on your objectives, how many of these activities you want to undertake in terms of how many resources you would need. I would say, we get assistance from our general consultant on ESG matters. I've worked with Ophir and used him as a sort of consultant as well, that we don't compensate.
Low-cost consultant.
So there's other ways to sort of collaborate with others and gain resources that way too.
And then the sort of an overarching question, what do you see as the goal of this kind of investing? Because if I think of the program, you mentioned it started 30 years ago, and tobacco was one of the initial foci of this effort. If the goal was to reduce tobacco consumption, clearly with 6 trillion in cigarettes produced today, 12% higher in the last 20 years. So clearly that hasn't happened. You also said it was a negative on the performance of the portfolio. So what goal, if you were to look back, was accomplished by this foray? Because it sounds like a noble enterprise, but as we all know, our goal here is to make sure our assets grow in a responsible fashion to pay benefits. And so while nobility is great, I'm just wondering what the overarching goal is. If you're trying to influence and change the world in terms of getting rid of tobacco or lowering it significantly, clearly that's not happened. If I think of the environmental impact of corporations, one of the largest polluters in the world, with no close seconds, is the Department of Defense. How do you incorporate that kind of a impact in, do you not invest in treasuries? Because clearly the Department of Defense benefits from the U.S. government-issued debt. Is there any divestment thought, any thought to divesting from defense contractors, from anything to do with defense? Just wanted to get a sense of what the board and the staff think of as the overarching goal of this enterprise.
Yeah, I think those are all incredibly important questions for you guys to scrutinize as you consider any of these actions. And ultimately, our board and our goals in this program are to make us better investors through that fiduciary lens. So ask the questions of our managers to ensure that they're casting a really wide net in terms of what could contribute to risk and return in the way that they invest. So it should be additive to that process. I think that's why you've seen a lot of investors move away from these sort of blanket exclusionary practices towards this more integrated approach of not necessarily taking binary decisions about a particular company, industry, region, et cetera, but to really think about where do we have pockets of risk that we might otherwise not have seen, looking at these extra financial variables that are environmental, social, or governance related. So it's not, the goal is not to impact society or to change consumer behavior or corporate behavior necessarily, but really to make sure that we're good investors, that the managers we give money to are the best investors in the world. Specific to something like tobacco, which I think is, demonstrative of a lot of divestment decisions, is it's really hard to predict the future and what may take place. It was a fiduciary-based decision when a lot of investors exited the tobacco industry. you know, the expectation that they would be saddled with, you know, billions of dollars of fines, that there was a ton of regulation in the U.S. around marketing products, huge increases in taxes, right, et cetera. I think what people failed to see, right, is that there's an international market that they can expand to, which is largely unregulated and continues to be in a number of areas. And if you have a product that's highly addictive, you have a huge amount of pricing power. So you can retain customers even with, you know, the extreme taxes that are being placed on it. So I think that decision was motivated by a real belief that the sector was in decline. Smoking rates are way, way down in the US, but that doesn't mean necessarily that something is not a good investment or may not return well for you. So that's one of the challenges, is to really consider the full picture of how companies operate, how regulations operate.
Maybe just to add real quick, you know, that decision at Spurs was made decades ago, right? Or
In 1998.
okay. And so if you recall the slide I had up there with the different approaches, the first one was socially responsible investing, which really is that sort of approach to this sector is morally objectionable, and so we're going to get out of it. And you're right to question the impact of that. But I think if there's one thing I would hope you take away from our presentation today is that that's not the approach that we're advocating, and that the market has, the practice has evolved a lot since then, and we're really focusing on that second area, which was ESG integration, really looking at the risk-return implications of these issues and how to become better investors, as Andrew said.
I think one thing to answer your question, which I've gleaned, you know, if you look at the oil stocks, which, you know, have underperformed a lot, right? And not necessarily because oil prices are down, because they don't seem to perform even when oil prices go up. And I've tried to understand it as an investor. And it is the fact that when you value a company, you put a terminal value on it. Now, if the terminal value is 0, you know, the valuation changes dramatically, right? And so if you say that under a certain scenario that solar and all these other things will replace oil entirely, maybe the valuation changes. As an investor, you look at it differently. And the question then is, you know, are investors that we allocate money to considering those factors?
Mm-hmm. So a couple more questions, if I may, Mr. Chairman. One is to Verity, and that is these 150 ETFs that you mentioned, do they have any kind of liquidity yet? Because clearly for them to be viable for a plan like ours and for other institutions, they need to have a very high level of liquidity. The other question, I guess, maybe for Sarah, is how do you incorporate this into a plan that is using indexing in a big way? So unless we have a S&P 500 that's ESG sensitive, or a collection of ETFs from BlackRock and others that we can piece together an S&P 500 type of portfolio, broadly diversified portfolio. How does one implement it in a plan like ours that uses a lot of indexing?
Just to answer the first question about the BlackRock's goals for ETFs, is that we expect to create new ETFs. So today, there's 0 liquidity because they're not created yet, but we do plan to create new ETFs in order to create more investment options across more index exposures, in order to develop the building blocks that our clients are asking to create a total portfolio that embeds ESG and sustainable investing practices. And also, as a follow-up, we're happy to deliver sort of the profiles and liquidity statistics for the existing set of ETFs that we have available in the marketplace today, which we do include in the category of the sustainable investment platform across BlackRock, and that could give you a sense of fund by fund.
So for plans that are like yourselves, really focused on passive investments, there's 2 broad areas you can explore, and dig more into in terms of educating and thinking about is, first of all, look at how your existing passive manager is voting the proxies and engaging on your behalf. And because there's a wide variety out there of passive managers, you're using passive at presumably relatively low fee, and so you want to look at the way the proxy is being voted in line with how you think they should be voted and compared to other providers out there. And if you're comfortable with that, then you stay with who you are. A second step is looking at possibly taking some of your passive allocation in a certain asset class and moving it towards ESG, or there's a wide range of different passive indexes that you could consider. And when you do that, historically, most of those have been come at a cost of a few extra basis points. But they're not necessarily with the promise of a few extra basis points in alpha. So you want to consider what you're doing since you're going to passive for low fee from that point of view of what you really think you might want to get out of it, what the focus is as a long-term investor, not to switch to something and something you would be happy to come back with and discuss options.
Andrew, can I put you on the spot to talk a little bit about SFIR's decision on the passive side, and maybe looking at what the performance has been on those passive indices, both before you invested in them and since?
Sure. So we have a passive allocation of $500 million to a low carbon index. It's performed, in line with its benchmark, Russell 1000 benchmark. That was a decision our board took to allocate $1 billion of our public equity portfolio to low carbon strategies. We did half of it passively, half of it actively.
Council Member Foley, do you have a question?
Thank you. I'm Councilmember Foley. I represent the City Council on this board. So I have a question for you, Andrew, regarding the Board of Supervisors and any policy direction. Did the direction to consider ESG and then become a member of PRI come first from the policymakers through the Board of Supervisors or through the Board of Trustees? How did that discussion begin and evolve?
Mm-hmm. We operate, independently from the Board of Supervisors. There is a member of the Board of Supervisors who also sits on our board, and other elected officials can be board members. Currently, our assessor recorder is a board member. So the decisions around our ESG policies and strategies come from our retirement board and those trustees. So they've initiated and directed staff to develop all of these policies. Our Board of Supervisors, specific to climate change, has issued, I believe, one, but possibly one or two, non-binding directives to the retirement system around the divestment of fossil fuels. That happened, I believe it was in 2013 when that initially happened from the Board of Supervisors. That's non-binding, so that's the extent to which they can exercise, their beliefs or communicate to us about investment-related activities.
We have the same relationship between City Council and the trustees. Of course, the trustees decide on investment strategies, but the council offers some direction. And recently, we declared a climate emergency, and we requested that the trustees consider divesting in fossil fuels. I don't think we were that specific at the City Council level, but do you take that non-binding directive into consideration then when you're investing?
Yeah, I mean, what we've done in response to climate risk was in January of 2018. We put in place what we at the time called 6 strategies to address climate risk. One of those strategies is to identify the highest risk oil and gas investments in our portfolio and take steps to mitigate those risks through investment-related activities. So hard to comment in terms of cause and effect, but the retirement system is acknowledging climate risk as an investment risk and taking steps that are prudent and that our trustees believe are consistent with their fiduciary duties to mitigate those risks. We've not divested the entire oil and gas sector, but we have restricted investments in certain oil and gas companies, 10 companies, and restricted investment in thermal coal businesses.
Okay, thank you. I appreciate it. One other thing, that was really helpful report by all of you. I appreciate it.
As Vikas mentioned earlier, one of his questions was regards to, the cause, the purpose versus returns. And I'm sure it's going to be a continuous evaluation going forward. The program in San Francisco, your other clients that have ESG programs, is this more of a pilot program for 3 to 5 years to evaluate, or is it, hey, we're all in, and it'd be just like any other asset class that we'll constantly just monitor?
For us, it's a permanent program within the investment team. To be clear, we do not have an ESG portfolio. So I'm not a portfolio manager. I work with our investment teams. So we, unlike some other plans that do have sort of carved out or earmarked a certain percentage or dollar amount of their investments that will be ESG friendly or sustainable or climate solutions, those are some of the terms that people use. We haven't gone that approach. We've said, our managers are professional managers. We want to invest with the best in the world. We think part of that is considering ESG risks in their process, but we're not requiring them to have branded or targeted ESG or climate or social impact strategies necessarily. Some of the strategies we invest in do incorporate those to a very significant degree. The reason we've invested with those managers is we think that those are unique strategies where that lens is going to contribute to their ability to generate alpha for the plan.
I might just add, from looking at our public pension plan clients, when people start it after, if they decide to move forward, it's typically it's a commitment. They're not deciding, well, we're going to try this for a year or two, but they're doing it very incrementally. So, for example, East Bay Municipal a few years ago decided, and particularly on climate issues, but overall ESG, they wanted not just education, but they wanted to understand it, and then had some educational discussions and developed investment beliefs, and then moved from there to have a education on all of their passive investments and what the implications are, and didn't move any assets, but then moved from there to hire their first proxy voting provider. They'd, prior to that, had a 30-year-old policy of vote with management across the board, no matter what the issue is, and went through a process to hire a service provider and develop a proxy voting policy that they thought that's, in this case, they're with Glass Lewis and using their public plans guidelines for investment voting decisions. So I would say the main thing is it's more incremental. Even if people are committing, it doesn't mean they're committing to, we're going to have 5 staff and we're going to put part of our portfolio here, and but really committing to thinking through it and how it might make sense for them.
This is our board's first introduction to ESG, and there will be more education as we go forward when we talk about developing a program if it's right for us. Is there questions that we are not asking that we should be considering in our thought process, to frame the discussion that we haven't asked based off of your experience with other boards or other conversations, conferences, et cetera. Yeah.
I think it would be a really illuminating exercise if you asked your investment consultant to ascertain which of your current investments are already integrating ESG.
I'd maybe add to that just questions around, should we develop beliefs around this? Should we develop a policy? Should we incorporate something into our existing IPS or have a sort of standalone policy? How do we augment our existing manager selection process with ESG considerations? And how do we leverage the resources that already exist so, to lessen any cost or resource burden associated with that? And that ties into your earlier question around, the program and how it can look. It can be dedicated staff, but many of our asset owner public fund signatories, don't have dedicated staff. They're just kind of augmenting their existing process. Their PMs, their analysts are just incorporating this into what they already do and leveraging resources like the PRIs and other organizations to do so.
I think probably you had
I think there's a member of the
Okay.
audience who had.
You want to come to the mic and state your name? Thanks. And then you had a question on the ESG stuff? You had a question in regards to the ESG?
Yes, I do.
Perfect. Yes, please.
Yes, my name is Charles Carter, retired San Jose Fire Department. I came on San Jose Fire Department in 1968. There was approximately $60 million in our retirement system then. Now we have just short of $4 billion. So I'm really concerned about the biases that this panel has presented. First of all, I really don't care about their being against firearms sales, companies that produce profits for people in the United States, which is Second Amendment right. I am concerned about the proper investments to give me the highest return so I can enjoy my retirement and my wife until we pass on. So if the board is here to listen to social biases about climate change, it really is this. Climate change by man is 1 inch on 100 yards. 1 inch. That's what climate change is. It's natural. I believe in climate change, but it's natural. It's not man-made. Thank you.
Thank you.
Mr. Chairman, I got 2 more questions, if I may.
Yes, go ahead.
First, I also want to thank the panelists for coming, making the trek. I know you came for the big payoff and compensation they were going to get, so appreciate it. I have 2 questions. One, I think, is for Verity. I think one of the things you mentioned is risk and integrating risk into portfolio construction. So can you tell us how it's quantified? When I think of portfolio risk, I think of standard deviations, I think of Sortino ratios, Sharpe ratios, and so on. How do you incorporate risk when you deal with the teams at BlackRock? And I think the other question I had was, you mentioned abundance of data. And my question is whether there is an abundance of data when it comes to emerging market corporations. Is there an abundance of data when it comes to venture capital investors? Do they provide you enough? How much transparency is there? And the last thing I want to say is somewhat empathetic to the member of the public that spoke. I also want to reiterate that our goal is to maximize returns at a prudent amount of risk. And I think that divestments may sound good, but I'm not sure that there's much data to actually be constructive in the management of this portfolio. Let me give you a specific example. For example, if I divested from sector X, what it does effectively is raise the cost of capital. The price of that stock or that sector goes down. If they need to come back to capital markets, they have to pay a higher expected return to future investors. And as I indicated with tobacco, nothing really in terms of long-run change may or may not be affected, most likely. So I think, in a sense, the marketplace can also be a guide to sustainable investing. For example, if carbon footprints are large, over time, in the S&P, you can have other companies, let's say solar manufacturers and so on, get larger and larger market caps. So in a sense, there is, if you will, constructive destruction already happening in the markets without having 9 individuals dictate what sectors to destroy or to divest from or to raise the cost of capital in. So those are my specific questions, Verity, for you in terms of the risk and how you quantify it and the abundance of data.
Thank you. So on the first question of risk, it might be helpful to provide a few examples. And maybe all of these falling within the climate risk analysis, kind of a framework to understand how we're thinking about this in the service of delivering stronger and more reliable risk-adjusted returns. As you say, our objective is aligned with yours 100%, which is to deliver the returns that you expect with an investment with us. So for example, in a muni bond portfolio, we're using data, geospatial data to understand physical risk, that is the expectation of rising floods and other extreme weather events on the physical assets that might be securing a certain bond, with the understanding of whether or not that bond will be repaid, and therefore the inherent higher risk in investing in such a bond. So that is one example where climate change could affect the inability of an entity to repay capital and therefore create a higher risk investment that should be compensated with a higher yield, for example. And through that effort of understanding the higher risk, you can then justify the expected return in order to compensate for that, for taking that risk and allocating capital toward that level of risk. Another example is we have some tools where we are looking at, for example, the carbon beta across sectors of a market of a public equities basket, where you can understand, or where we're modeling, frankly, expectations on price earnings multiples. So stocks are often valued on future profits. So if you can understand which sectors or industries are going to benefit or suffer from a transition to a low carbon economy, that is sort of a judgment, number one, that you think over the next 10 years there's going to be a regulatory environment requiring certain activities, and that's going to be reflected in consumer and other sort of demographic shifts, which may influence your expectation that 10 years forward, what products sell and services sell may be different than what it looks like today. And so you might be able to model then through this carbon beta exercise the expected future profits, and therefore assign a multiple on how much you're willing to pay today for a stock that you think is going to deliver that in the future. And there's another example, at a more micro level, if you're just looking at GM and you want to know, I want to invest in automobiles, and do I like GM versus VW? Do I like GM because it's got a huge electric vehicle push, or do I think they're ill-equipped to manage this new mega trend? So large sort of physical fixed income equities, there's lots of ways to measure risk. And we're also working to aggregate those more discrete measures into a total portfolio kind of risk assessment. Those are some examples of risk measurement. On the question of abundance of data, and you mentioned some dimensions of that question between public equities and public securities and private securities, emerging markets and developed markets. So certainly, when we're talking about the availability of sustainability or ESG data to analyze, it's true that historically the larger companies, the larger developed market companies, have been more likely to furnish this data. That said, in the private investment realm, both on the equity and the credit side, you get access to information from the entity to which you're considering allocating capital in a much deeper level. And so given the type of instrument that allows for due diligence over a timescale of a week or more, you can ask very detailed questions, and that's what our team does. So, for example, our private credit teams use the SASB standards, the industry-specific standards, to understand if a company is operating in a specific one of the 77 industries, what are the material, environmental, and social issues we ought to have a handle on and know if that entity is aware of them and managing them well in order to understand if we allocate capital to that entity, if it's going to be a higher risk, therefore we should expect a higher return to compensate taking on that risk. And on the private equity side, that's also true. The industry-specific approach to analyzing a given company and understanding how is it managing, is it aware of risks, how is it managing those risks that are inherent to operating in a given industry. And so that can definitely happen with almost a more sophisticated, in some cases, level of information that's more targeted toward what the investor wants to know. We're also doing that on the emerging markets side. So one of the examples I showed in the slide that has the 4 boxes includes our emerging market debt team. This team at BlackRock has long held that corporate governance is a very strong indicator of quality and risk, and also has been over the past few years, been increasing the information that it seeks to understand in terms of environmental exposures and social exposures. So if you think about social unrest in Venezuela, and you want to understand if you're investing in companies in Venezuela, how that dimension of community and social risk might impact a given company's operations. Our team has the ability to fly to Venezuela, meet face-to-face with that company, understand, and then ask those detailed questions, not only in the context of the emerging market regulatory framework in which that business is operating, but in the industry-specific materiality approach to, again, understand the risk and then understand how the team would value that risk and what return would be expected for taking that risk.
Thank you very much. Okay. If there's no other questions, I definitely appreciate, thank you for coming out, having this educational session for us. Like I mentioned earlier, this is our first endeavor and conversation around this area. Lot to digest here. If Prabhu has any parting comments, he's welcome to say something.
I just want to echo Andrew, the chair, to thank our panelists. They don't have to be here, but they've taken time off their busy schedules to come and educate us. And let there be no doubt in anyone's minds, our goal is to maximize returns for our beneficiaries. But having said that, we were directed by the City Council to take a look at certain aspects of our portfolio. And I did promise the board that we will have an ESG education session. So again, thank you for being here. And we will continue these discussions internally. Thanks.
All right.
Thank you.
Thanks, everybody.
Thanks.
Let's go ahead and let's come back at 11:10. Take a little break real quick. Everybody could take a seat. Let's go ahead and get back into session here. Before we leave the investment section, we do, Mr. Carter from the audience had one more question on investments. And so why don't you go ahead and come up and ask that question before we move on? Yes.
And before that, come up, Charlie, through the chair. The reason I invited him here, I actually came on at 68 also, but that ain't the issue. Charlie reflects a lot of the retirees who call me and call Nick and so on. How come our investments are this way, we make money, you guys are not, you know, whatever. Of course, we have a tendency to want to defend that, right? And I always said, you know what, see if you can get involved and come down and ask those questions, because we have at least 4 expertise here. And I said, then the city has restrictions that I don't like. But that's the way this is run. If I could do it my own way, we would do it like we do together. So the best way is come down and approach the board, and if we can out of this dialogue, when we have our quarterly or our newsletter, this is the kind of some of the things we need to make sure the retirees can hear about. So they don't have the chance to come down here all the time because they don't necessarily live here because they can't afford to when you're retired. So these are things I think we should address. So thank you for coming, Charlie, and thank you, Mr. Chair.
Yep.
Again, my name is Charles Carter, retired San Jose Fire Department. I live in Tahoe, so it's a beautiful place to be, and they don't have to pay state taxes, which is a big help for retirees. So my main question is, because of my concern is, when I came on and it was a new retirement system, the goal was 8% return a year, average, 8%, to make the system work. So I was concerned when I saw there was a 2 minus 3% return 1 year. And this is in the last 3 years when the market's been up around 12% or more. So are we in this limited retirement mode that the city council has directed? Or this is an investment board that gets the best investment possible in the parameters that you work with? So that's my question. And there's a lot of other firefighters had the same question. They're not here. So.
No, I appreciate you answering the question. Prabhu, do you want to answer that?
I'll take a shot at it. It's directed to the board, but I will take a shot at it.
Oh.
I want to thank Mr. Carter for an excellent question. Thank you, sir. So this is an issue. This is a real issue that we've been grappling with. Firstly, our target is not 8% anymore. It's now 6.75 over time. We've reduced our target because market returns we expect will be lower going forward. It won't be like the last 10 years. The last 10 years have been good, so a reversion to the mean. So we expect it to be somewhat lower going forward. And there will be years when there could be a minus, but on average, we expect it to do well over the long term. And as our consultant pointed out earlier, calendar year 2019, our return was close to 14%. But you do raise a bigger question, and why do we not do, I'm going to sort of paraphrase your question a little bit, and forgive me if I'm doing it incorrectly, but the question is, why are we not doing as well as some of our peers, right? And this is something that we grapple with all the time. And one reason is the bull market started in 2009, the current bull market, so we've been in a bull market for 11 years, but we don't take as much risk as our peers do. And risk and return go hand in hand. And this was a conscious decision by the boards in deference to, I would say, again, correct me if I'm wrong, I wasn't here in 2009, in deference to the wishes of the city and the sensitivity of the city to the annual contributions that they make to the retirement plans. So it is a great question, and the only way we're going to get the type of returns that you're looking for over an extended period of time, say over the next 10, 20, 30, 40 years, is by increasing our risk. And this is a question that came up in front of the boards last year, and the boards did nudge up risk a little bit. And it's a question that will come up before the investment committee and the board again this month and next month. And so this is a real issue that we will grapple with. Should we be increasing our risk? and how sensitive should we be to our sponsor, right? And so, to answer your question, sir, I think it's a very valid question. One of the reasons why we've underperformed our peers is we've not taken as much risk, and that's for a variety of reasons. And I think we did nudge up the risk last year, and we will see what the boards decide in the next month or so. So that's just from my perspective. I'm happy to let trustees answer that.
Yeah, so, I mean, since I came on the board about 4 years ago, we have spent many meetings and offsite meetings discussing about asset allocation and risk tolerance of the plan and our sponsor and our membership. This is something that we discuss continuously throughout the year. Prabhu came on board about a year and a half ago, I believe, or so like that. He has a great, strong team underneath him, and his leadership is bringing up all this different information and data for us to evaluate. So to answer your question, are we focused on our investment returns and trying to get the best returns possible? Absolutely, 100%. But we are also very cognitive of the risk profile that we have and of the sponsor and what we can tolerate. As he was talking about this month, we have an investment committee that's going to be meeting end of March. And we're going to start having that discussion again about asset allocation. Is this an appropriate time to increase our risk?
Well, could you give me an idea why we're in this low return mode when in the past it was market-driven returns for the fund?
Andrew, let me just cover one other part. He keeps mentioning risk, but there's a specific reason for the risk, and my name's Frank, I'm the police active. We are in a situation now in this city where we have more people in retirement than we do actively working, which means we got to kind of keep a lot of money in the checking account. So in order to do that, we also have to control that risk level. If we take too much risk and we have a big downturn, then that's very detrimental to our group. So there's a balancing act of trying to maintain those levels. Does that help you to understand that a little bit?
Yes, it does. I did some research, and it's roughly $270 million you're paying out to retirees. Is that correct?
Yes.
Yeah.
Approximately? So if you need $270 million, obviously you need a big investment portfolio that's going to support that.
Yep.
And it's going to continue to grow until we get to that second level of retirees who get a small return. And that may take about another 10 years. I have about 10 years left to go, so you won't be seeing me. It's a possibility. I actually surprised myself. My goal now is to get 90. But anyway, I appreciate your time, and I really hope that you consider investment portfolios that include index funding instead of worrying about people taking a little pie home from themselves. This group here, I'm sure they did a nice job, but I'm not interested in social climate change. I'm interested in returns. So thank you very much.
Well, I appreciate it. Thank you.
Thank you.
Thanks.
Thanks.
Safe travels.
All right, let's go ahead and move on to new business. 4A, oral update from our CEO, Roberto Pena.
Thank you, Mr. Chair. So a couple of things I want to share with you. Number one, I'm going to be going to the City Council on April 7th. So Ms. Foley, you know now that I will be there to present the report on the actual evaluations that were discussed with you and presented by Chiron over the last few months. Also wanted to let you know that we issue an RFP for legal services that was posted last Friday, February 14th. Is scheduled to close on March 16th. And once we do our due diligence, we complete our work, the goal is to come back to your meeting in June with recommendations. And we're talking about general counsel, tax, disability, and so on and so forth. So we're looking for a different scope of services. I also wanted to let you know that the annual member statements have been mailed, and members should start receiving them. If they haven't received them already, they should start receiving them this week. So, especially for those of you that are active members on the board, if you get calls from members, you should know that's what they're referring to, and if they have any questions, certainly we encourage them to contact the office. We will be performing interviews for a senior analyst position later this month. I also want to remind you, you should have received by now an email from the city clerk's office reminding you about filing your Form 700. The Form 700 is due on April 1st. You may, until you file that form, you will continue receiving emails from the city clerk's office. And if you have any questions, please contact our office. We'll try to be as helpful as we can. And if we cannot be helpful, then we will have to turn to our attorney to be helpful on filing the Form 700 to the extent possible.
We get notices even when we do file.
That's right. Staff is working on the second newsletter that we're going to be issuing sometime early April, so stay tuned. You're going to like the newsletter. I will be attending the Calipers General Assembly. We have received questions from members and trustees whether the conference is still ongoing, and it is. It starts on Sunday afternoon. The Calipers board had a meeting yesterday. We decided to move forward with it, mostly because the CDC at this point has a very low rate in terms of impact, at least for the U.S. and this area. If anything changes, obviously we will keep everyone apprised. But the Calipers General Assembly is at this point is still ongoing from afternoon on Sunday to Tuesday morning.
Where's it at, Roberto?
It is in the Palm Springs. And then lastly, just wanted to let you know, we sent out a doodle for the JPC meeting just recently. And this is for those of you in this board that are members of the JPC. If you can let us know your availability so that we can try to schedule the next Joint Personnel Committee meeting. That, Mr. Chair, concludes my report. I will be presenting, the next item will be the budget presentation, but I'm happy to answer any questions.
Any questions? All right, thank you. Let's go ahead and move to 4B, oral update from City Council Member Pam Foley.
Great. I just have two items. We're heading into budget season, and the mayor will be delivering his budget message tomorrow afternoon. I have no idea what the budget message will say, but I'm hoping that it will include an allocation for increasing funding for sworn officers for public safety, including 911 dispatchers, et cetera. We have, from the city level, that's the number one thing we hear about, is concerns about public safety and crime and traffic enforcement. And so increasing the police department in particular will help that. Additionally, we just finished priority setting session, which occurred 2 weeks ago, and I was really happy to present a survivorship benefit, continuing survivorship benefit for the firefighters. You'll recall in November, this body passed police survivorship benefits based on spouses who were entering into new relationships, getting married, their survivor benefits go away. So that was a positive effect for the police department, but there was not a mere survivorship benefit at the fire department. So I submitted a priority item in relation to the firefighters, and it was green-lighted. It didn't go through the normal priority process already. Staff is already working on it with the bargaining units. I know they have to deal with it at that level, but I don't see any problem with that going forward, and we should be able to approve it and adopt it towards the end of this year.
Thank you.
Yeah, thank you very much.
With that, I conclude my report.
All right, appreciate it, thank you. 4C, discussion and action on the Officer Retirement Services proposed administrative budget for fiscal year 2020-2021.
Thank you, Mr. Chair. So I moved from my usual location to the front so I can not only see all of you directly, but you can just look this way rather than having trustees next to me. What you have before you are 3 documents. I am going to strictly keep it to the budget presentation, the PowerPoint, which is the middle one. But what you have there is the proposed budget memo, along with some other documents that are required. Now, you may recall, as part of the city audit of our office, that among many of the recommendations included a revamped new budget process that would require us to provide more documentation to the city. So this is the 3rd year, I believe, where we have implemented this approach. So what you see there, besides the memo and all the other information, is exactly that. But if you have any questions about those documents, I'm happy to answer them before we start the presentation. And if you do not, I will jump into the PowerPoint. I apologize up front. This is not as interesting as a presentation on ESG, but I promise you that I will try to make up the difference with energy and excitement, all right, before you. So with that said, Linda is downloading the budget, and if you go to page 2, which we will do in about 3.7 seconds, that's part of the excitement.
You're funny.
All right, so page 2, that's just the, it's not moving. Well, you do have the page 2 before you, and so at a glance, I just kind of wanted to go over what you're going to see before you in the presentation. You have the administrative expense breakdown. As part of the documents that we provide to the city, we agreed to provide some sources of funds and uses of funds, and then you have the actual administrative budget that we are proposing, which, as usual, it is split in 4 main buckets. And those buckets are personnel services, non-personnel equipment analysis, professional service, medical services, and then we close out the presentation with analysis and comparisons to other California plans that are similar to us. If we go to page 3, I just wanted to explain to you a little bit the information that we use and the analysis that we do to prepare the sources of funds and uses of funds. So the sources are, as you may expect, city contributions, member contributions, and then, of course, investment income. Now, investment income is a key component of that bucket, and the reason I say key is because, as is indicated in there, it's calculated using the assumed real return based on reserve plus city contributions for the whole year and other activities throughout the year, which means we're just going to assume that we are going to make the assumption rate of 6.75. The truth of the matter is we have no idea how much investment income, if any, we're going to produce throughout the fiscal year. Well, for purposes of preparing the budget, we assume a 6.75. And then, of course, the uses of funds, which is what we are here for, is to really pay benefits and health payments, make benefits and health insurance payments throughout the year, and then, of course, the administrative expense on keeping the office going to properly administer the plan. On page 4 of the presentation, just quickly wanted to let you know, again, those are the 4 main buckets of the budget presentation, but a key issue here is personnel services. Ideally, we would like to keep track of what we do, the staff does every day, day in and day out, spending time on managing and operating the police and fire issues and federated. The truth of the matter is that we don't have the time and the resources to keep track of that. So for purposes of preparing your administrative budget, we just assume that is evenly split between 50% federated, 50% for police and fire, except for the investment staff. And in that situation, we used to use 50-50, but about 4 years ago, we changed to do more of a ratio based on asset size, and based on the total assets of both plans, about 60% assets are police and fire, the other 40% is federated. So for purposes of the personnel-related costs for investment staff, we assume, instead of a 50-50 split, we assume 60-40. Any questions so far? Again, the non-personnel equipment is the overhead costs such as rent, supplies, equipment. These exclude professional services, which is the next bucket, professional services, legal, actuarial, IT, and other professionals. And then lastly, the medical services, which is really an estimate based on the contract by our medical advisor and other independent medical examiners based on the average of the number of applications that we go out throughout the years. Key note here is to remind you that the budgets does not include investment professional services, consultants, and investment manager fees, or any capitalized costs. So for example, we have, as you know, the pension administration system, which was initiated, that whole project about 4 or 5 years ago, at a total cost of about $9 million. That is actually, those costs are actually capitalized throughout the year. They're not really part of the administrative budget. And so with that, any questions? We'll go to 5 and 6, the exhibits. On 5, I just want to show you the sources of funds. Again, this is based on investment income assumptions and the actual contributions by the members and the city for the prior years are based on actual. For the year that is currently ongoing, that closes on June 30th, is still forecast number. And then, of course, what we're here for you this morning, which is the proposed budget for 2021, those are the proposed numbers. Although we do realize the city contributions actually are based on the participant on the information provided by Chiron on the presentation that they made the last few months. Same for the uses of funds. Those are the numbers that we actually have produced over the years. Just a clarification, when the member was just recently here speaking about the total police and fire benefit payments, I think he mentioned 270. As you can see, for the fiscal year 2021, we are proposing about, or we are calculating about $235 million on benefit payments for pension benefits. But when you add the 26 for health insurance, that actually gets close to the 271 million. So it's a combination of pension benefits and health insurance. So lastly, we go to Exhibit 7, which is actually our proposal. As you can see, a couple of things. All these numbers are actually based on, number one, experience over the last few years and expectations of our work plan for the coming year. And so we starting with personal services. That's it's pretty straightforward. It's based on compensation costs, which includes fringe benefits, and that's provided by the city. The main difference in this proposed for this year is actually, I'm going to take you quickly to Exhibits 8 and 9 to speak about personnel. If you go to Exhibit 8, you can see on the 1, 2, 3, the fourth column on the proposed number 2021. The proposed authorized position for both plans is 40.75. And if you see the forecast for 19 and 20 is 39.75, and the reason for that is we are proposing to add one more position for the new year, which is actually a senior investment position at the investment office. And if you go to the next slide, which is the exhibit of the org chart, it actually goes over the org chart for the office that indicates on the left-hand corner on the top the senior investment officer position. Just wanted to indicate that's probably one of the main reasons why the proposed budget for personal services is going up, other than, of course, the costs associated with increasing compensation and fringe benefits, which is provided by the city. So if we go back to, I apologize, and if we go back to slide 7, non-personal equipment, we will provide the detail, but the proposed amount is $1,250,000, which is an 11.22% decrease from the adopted budget from last year. It is higher than the forecast that we had this year based on how expenses have transpired throughout the year, but it is a reduction from what we requested, and it was approved by your board last year. The same goes for professional services. It's a 4.20% decrease from what was proposed and adopted by your board last year, even though it's a higher number than what we are forecasting for the current year. Again, that forecast is based on how the expenses have behaved throughout the year, although at times it could be a situation where there might be some expenses that we had not received yet, and so we will receive them later before June 30th. And then in closing, medical services. Again, this is based on is 8.26% increase compared to what was adopted last year, but a sizable increase to what is forecast. And let me just make a little comment on that. Is again, this request is based on our expectations, based on prior years, on the number of cases that we have dealt with throughout the year. Clearly, the forecast for the current year means that we have actually handled or dealt with less cases than we were expecting. But when we look at the overall number of years, we still feel that we are going to be expecting to deal with more cases in the coming years. So that, in addition to an increase in the contract for the medical advisor, indicates it really is the support for the reason that we are requesting the $236,000. When you look at the combined request of $6,485,000, is just a tad below 2% more than what we requested last year, and it was approved by your board, although it is just about 18% higher than what we are forecasting for the fiscal year that is ending on June 30th. One last comment on this request is just a reminder that we actually make sure we don't come back before you unless a particular main bucket is going to be exceeded. So, for example, is that correct, Benji? So, for example, non-personal equipment, if for whatever reason we are recommending $1.25 million and say come is March of next year, and we see that we are forecasting 1.3, then we certainly come before you to request an increase on that particular bucket. I mentioned that because it is quite possible that, you know, we have, we will never exceed the main buckets that we requested. So again, you will never see us going over the 4 main buckets that add to $6,485,000. We will only come back before you if any of those 4 buckets we feel that will need to be exceeded for whatever reason, and if we have any particular reasons at that time, we'll certainly bring them forward to you. Any questions so far? What I'm going to do next is go over the specific, just to show where these particular numbers are coming from. Yes.
Just on slides 5 and 6, the big difference between the sources of funds and uses of funds is the city paying the funding gap, right? The big difference between sources of funds.
No, it's not to be viewed that way. Yeah. It's not that the sources, the city contributions are based on the actual evaluation. They don't take into account the gap between the sources and uses of funds. It's not a cash flow issue. It's more of a...
The actuarial issue, right?
Yes, it's an actuarial issue. That's correct.
Yeah.
Any other questions? So if we go, again, I already mentioned on Exhibit 8, the only comment I want to make there is that, of course, it's 4.75, accounting for asking for one more position for the new fiscal year, but because obviously the split between both police and fire and federated are 50-50, it comes out to 20.375 full-time employees allocated to each plan. So in terms of personal services, I just want to to provide some background on it. The requested amount does include the budget of 2 return to work retirees for the full year. It also includes the additional senior investment officer. Also, an add and delete on the benefits area from a staff specialist position to a benefit analyst position. And lastly, the last year of the limited day information system analyst. That position, which is by definition limited day, means that it's not a full permanent position. It's limited to a timeline. And so this coming 2021 fiscal year is the last year that we're going to have that limited day information system analyst position. Again, slide 9 is just to provide you a concept of the org chart, and because Prabhu requested repeatedly over the last 2 years, finally convinced me to make sure that I provide a more accurate org chart. You see a dotted line of the CIO to the CEO, and a complete line going to both boards of retirement. Prabhu, so that's for you.
Thank you, sir.
You're welcome. So now for the non-personnel equipment, again, the proposed amount is $1,250,000.
Roberto?
Yes, sir.
I think Vic was asking whether we could go back to number 8.
Number 8? Yes.
It's obviously caught my attention when you said add and delete, disability analyst. What's add and delete?
So what happened is it reads disability analyst, but it's the disability benefit analyst. And so what that means is that that position now is being covered, or it was covered by a staff specialist. Now that position, instead of being a staff specialist position, is really a benefit analyst position. That's all it means. So it doesn't really have any impact on the operations. We still have the same personnel working on disability. It's just that that particular operation, I think, is more designed for a benefit analyst background as opposed to a staff specialist. That's all it means. So going back to slide number 10, non-personnel equipment decreased prior year budget by $200,000. And again, the decrease that we're trying to explain there is based on the adopted for the budget. So a couple of things. Investment analytics and research budget was reduced by $131,000 for State Street for performance analytics in order to align with the recording of the CAFR. And let me explain that because this is critical, and I'm going to use that explanation to compare to something else that is later in the budget. You have heard me say repeatedly over the years that when we come before you to present the administrative budget, under the definition of California Code for retirement purposes, investment expenses are not really part of the administrative budget. And investment expenses are to be reduced directly from the returns of the plan so that you actually deal or end with a net return on investments. And so what we're doing here is more of an accounting adjustment to make sure that we clearly keep those investment expenses away from the administrative budget and to be aligned not only with the CAFR, which in the CAFR, which is the Comprehensive Annual Financial Report, doesn't include that investment expense on the administrative budget, but also to align with our peers across the state. This also brings 2 issues that I want to comment, which is I have chosen over the years to, as part of the investment expense of the administrative budget, to include the personnel expenses for the investment staff. We could take the position that because those are investment-related expenses, that would not be part of the administrative budget. But I have taken the position not to delete or limit those personnel expenses for for the investment staff from the administrative budget. But this also brings another issue, which is, if you allow me, if you go to slide 11, that $1,250,000 includes $435,000, just almost 40% of the total budget. And you can see it's the highest number, and it reads investment, analytics, and research. I decided to keep this amount in the budget this year for sake of continuity with prior year's presentations. But I just want to let you know, starting with the budget from 2021, we will no longer include that number on the request for non-personal equipment. And the reason for that, again, is the same reason why we are deleting the State Street performance analytics, is because investment-related expenses are not to be part of the investment of the administrative budget. So,
just weighing in real quick, I think that's a smart move to phase it in gradually, Roberto.
I'm sorry, say that again?
I think it's a smart move to phase it from one pot to the other gradually.
So, and the reason this is important also, and I have some numbers to share with you, is when we get to the end of the presentation and we have some comparison of our office administrative budget to our peers, in order for them to be more apples to apples, we should not include that $435,000. Now, the numbers that you have in the budget presentation this year does include the $435,000, but when we get to that point, I'm going to give you also the numbers without it, because going forward, that's going to be the approach. So going back to slide 10, LRS, which is the firm that actually implemented or came up with the new V3 pension administration system, the annual maintenance was reduced by $62,000 due to the implementation of V3. And it also included an increase of IT of $25,000 due to planned projects. We have been looking at, for requests, fund center kind of an approach, and also social media. I'm going to be coming before you next month with our communications consultant, presenting a communication strategic plan for the next few years, which include social media. So that's included in the budget. So going back to slide 11, in addition to the $435,000 on investment analytics, we have $212,000 on rent, $193,000 on insurance, and so on and so forth. I'm not going to go through the detail other than to answer any questions if you may have any, but what I do want to key in here, just as an example, we have the rent of $212,000. Most of you know, which I have kept you apprised of, our 5-year lease ends at the end of this month, and we are in the process of signing a new lease for the location in our building, and so it does include some increase in rent. So it is quite possible that the rent expense for 2021 may end up being more than $212,000, but if the total non-personal equipment doesn't really get to the $1.25 million, we would not come before you to request an increase in rent, because the total bucket amount will be less than the $1.25 million. I just wanted to give you that as an example. So going to slide number 12 for professional services, again, the main reason for the reduction is on professional services is last year, or when I say last year, I mean the year ending on June 30th. It included an experience analysis prepared by Chiron, which is not required for the coming year. That's the main reason for the for this amount requested. Now, during my audit report, I actually mentioned that we issue an RFP for legal services. I don't expect to have to come back before you with a new proposal for professional services, but if for whatever reason, when we go through that RFP, the cost associated with providing legal services is considerably higher than we expected, there's always a chance that we may have to do that. Not right away, but that's always a possibility, but at this point, we don't expect that to be the case. And so again, slide 13, it just go over the various expenses for the consulting for professional purposes, the largest being legal, 317,000, actuary 235,000, the financial audit that is completed by Grant Thornton on the annual basis, 83,000, other professional services, 78,000, and again, I won't go through all the details, but if there are any questions about these particular numbers, I'm happy to address them. And then finally, going over the medical services analysis, as I mentioned before, there was an increase in the costs associated with the medical advisor in her contract. This proposed amount takes in consideration experience over the last 5 years and an expectation of so many applications that we're going to deal with throughout the year. And we feel confident. This is based on 3 cases per month. And again, if the cases, they turned out to be less than expected, then the amount is going to be lower. If for some reason we become really efficient and the cases are a lot more than we expected, we may have to come before you to request an increase. But suffice to say that this is based on experience, and we're hoping and we expect it to be someone around that amount at the end of the fiscal year. So that actually concludes the actual presentation on the administrative budget request. The next few slides are, we started this about 6 years ago, a way to compare our office administrative requests with our peers. And so what you see here, the first slide is personnel services analysis. And I'll caution you on this particular one. Again, usually your compensation and fringe benefit costs in the Bay Area is going to be a bit higher than in other locations across the state, so keep that in mind. So in your case, police and fire, the actual for 2018 was 9 basis points. If you look at the combined federated and police, that's 10 basis points. If you compare that to the average for other pension plans, if you look at the average for 0 to 5 billion, which is along the line of police and fire, you are right there of 9 basis points. But if you look at the average for 5 to 10, which is when you combine our 2 plans, then we are just a bit higher than our peers at 10 basis points. And so, you know, when I present this graph to Federated, they always complain. And then when I present it to you guys, you're happy about it. And that's because, obviously, generally speaking, this is based on a 50-50 split between the 2 plans, except for the 60-40 on the investment staff. But because you have a higher base, your basis point come out to be a bit lower. I thought you were going to mention something.
Well, so, right, Roberto, we would always be higher than our peers because you have that dual nature, right? So we should never expect to be in line with our peers. We should always expect to be a little higher unless there's some other system that has 2 or 3 distinct boards and everything else.
So very good point. That is true. And then the other point that I will make is we would expect the system in the Bay Area to be a bit higher than other areas across the state.
But we could compare that to, say, Oakland and San Francisco.
That's exactly right.
Measure that out, yeah.
Yes.
Are there any other systems, Roberto, that have multiple boards that or Harvey, that you know of? There are, so we could also do that.
There is, well, I know right off the bat, I know of City of Fresno.
Yeah, right.
That's one of them. For City of Fresno, how can I say this in public correctly? Well, no, listen. No. Let me just say this because I've been very honest over the years. It is my understanding, I could be mistaken, that the 2 boards of the City of Fresno are very similar in their behavior and their approach. The same cannot be said with these 2 boards. Federated and Police and Fire have a very distinct approach, very different. Now, of course, I can't say much about Federated these days because they did have a huge turnover. They have about 4 new trustees over the last 6 months. So that still remains to be seen. But my point here is that I think it is a little more challenging to deal to conduct business when you have 2 boards that are very different to each other, which is not the case for the city of Fresno.
I'm not looking for you to go into great details, mostly aimed at you, Councilmember Foley. If somebody asks at the council level, tell them we could tease it out if they'd like to, but we haven't ever seen a need to, because I think we trust Roberto to say, 5 or 10% higher, and that's probably explained by those 2 factors.
So, oddly enough, the Retirement Working Solution Group, they meet on a monthly basis and they look at all various issues. And one of the issues that was brought up recently was the joining of the boards. And the mayor, who was sitting nearby, looked at me and goes, gee, other than Roberto, I'm not sure anyone is going to be happier than him if we join the boards, right? And so I responded, well, if you're going to join the boards and make a board 16, I won't be happy either. So, but the point really being, in terms of cost, and this is a question that was asked, I think the city and Sheriff Parkman particularly, was given the difficult, challenging responsibility of estimating, getting an understanding, if we merge the boards, what are the savings that we can be looking at? And so I don't know the answer to that, other than to say, quite honestly, the staff has gotten so efficient and effective on dealing with 2 separate boards, and also on the investment side. When I first joined, there was very dissimilar investment programs. They're still not quite the same, but they are closer. So we do take, in addition to that, when I first joined your boards, we had 2 separate investment consultants for the 2 plans. Now we have the same consultant. We take, so we reap the benefits of having 1 consultant in terms of the cost, but also whenever we, both plans have reached out to invest in an asset class, we have tried to the extent possible to also reap the benefits of using economies of scale with investment with the money manager. So we also are getting the benefit of that. So quite honestly, I'm not sure what the cost savings will be right off the bat. In fact, I will argue that initially it may be even more expensive from the standpoint, and this is just a complete educated guess on my part, it will be harder for a brand new board of whatever number of members there may be to learn to work together right off the bat, especially if the new board is comprised of current members of the 2 boards. That's a complete educated guess on my part. On my part, I have no proof that that will be the case, but it will seem to me that it will take some time for that new board to really learn to work together, since they have been 2 boards for the history of this plan. So with that said, I'll go to the next slide, which is...
Got one question.
Oh, yes.
Oh, no, I was just going to offer another example of a charter city, Los Angeles. Los Angeles has 3 retirement systems, the civilian and fire and police, they flipped the 2, and a Department of Public Works. They have separate boards, they have separate staff, so each one has its own investment staff.
Plus tiers.
Each one has its own general manager, CEO.
Do they
Yes.
share any costs already?
What's that? No.
Do they share any admin
Nope.
costs?
None at all. We can pull those numbers for you. They're clients of ours, so we could pull the administrative numbers for you for comparison and tease it out of here.
Yeah.
But in terms of a spectrum of efficiency, San Jose is probably way ahead of, just in terms of per capita cost.
Thank you, Council. And let me just add that is absolutely true. I apologize if I misunderstood the question from Trustee Lance initially. I thought you were coming from the standpoint of having 2 boards share the same staff. That was That's why I gave you the sample of Fresno City alone. But council is completely correct. I mean, the city of Los Angeles have 3 separate staff, 3 separate boards, and 3 separate everything. But just
Yeah.
one plan sponsor.
Yeah, I mean, I think do the same thing you do, Roberto. I look at how we deviate from sort of the curve, and I say, well, there's 2 factors there, 2 boards in the Bay Area. So if I just split it in half, you could probably look at that and say, maybe the fact that we have 2 different boards is worth $300,000 or $400,000. That's a really crude analysis, but it's probably within an order of magnitude.
That could be possible.
And just from looking at the BPS deviation off the curve, yeah.
So if there are no other questions or comments on slide 17, quickly, this is a comparison with the administrative cost. I do wanted to mention, Benji, if you remind me, what are the systems that are included here? You used to have that somewhere, but I don't see it now.
There's 23 public plans.
So it includes 23 public pension plans. So when you look for that, let me just quickly say about the administrative cost. So for the combined plans for 2018-19, 70 basis points compared to 13 basis points. So that's a bit of more of a difference there for police and fire, 15 basis points versus, which is interesting, right? If you just look at police and fire by itself, it's 15 basis points is less than the 16 basis point for the California plans between 0 and 5 billion. But if we decrease, if we take out the $435,000 on the investment analytics, that number goes down to 13 basis points. So it will be 13 basis points compared to 16. For the combined plans, that number will go down from 17 to 15 and a half. So again, compared to the 13 basis point for California plans of $5 to $10 billion. So just wanted to make that point. So if we do it more apples to apples, I think those basis points comparisons are closer to what our peers across the state are. And so if you wanted to mention what they are.
So I'm not going to mention all of them, but some are Alameda, Contra Costa, Fresno, Los Angeles, San Diego, Kern. So
Do we have, so we have Contra Costa, Alameda from Bay Area, any other? We have San Mateo.
San Mateo, yes.
Do we have?
We don't have San Francisco.
No, have San Francisco? Okay, all right. So we do try to include not only Bay Area, but other systems across the state of California. So I think lastly, the last slide is the administrative cost. Is the same comparison, but instead of basis point, is dollar figures. So again, for police and fire, the 5.5 will go down to $5 million if you take out the $435,000 on investment analytics compared to the $4.1 million for pension plans in the 0 to 5 billion. If we take the combined number of 10 and a half, which it will be closer to 10, compared to the 10 million for public plans between 5 and 10, will be right on the money on that one. Benji, the 435, is it 435 for each?
Yes.
So actually that number will be below the $10 million on the combined plans compared to our peers.
Correct.
Yes. So that, again, the last 3 slides is to give you, not only your board, a sense of how we compare to our peers, but also to the plan sponsor, how do we compare to our peers in terms of the administrative budget. Lastly, what I want to close it out with is because of the city auditor request to have provide more information to the city budget office and to the city council, which in fact, when we prepare these documents, I actually take the documents and share them with my contact person at the mayor's office, the city budget director, and with our city liaison person, Sheriff Department, so they all have the same documents. And then I will be going to the city council in May to present the budget request. Nowhere near as detailed as this, is more general information, but nevertheless, the city council does get the detailed information that you board received, which was kind of the main point of the city auditor, to make sure the city council and you boards receive the same documents and information. So with that, I'm happy to answer any questions.
Go ahead.
Yeah, so Roberto, so I might have missed this, but so the 435,000 for investment analytics, the other plans do not put it as part of administrative expenses.
So I don't know if they have any investment analytics, but they do not include any investment expenses in the administrative budget.
Okay.
Yes. Other than maybe some of them
Yeah.
may include investment staff related expenses, just like we do here. But I'm aware that some others do not at all.
You know, we always have this conversation. I think this is exactly right, Roberto. We always measure things absolute and relative. So then apples to apples is important, right? And then absolute, we'll have a different conversation. You'll say, you know, guys, if I hire 1 or 2 people here, it'd be really interesting. That's a different conversation, yeah.
Any other questions for Roberto on the budget? If there are no other questions, this is something we need to take action on and approve.
I'll move to approve.
Okay. Motion by Lanza, second by Millo. Sorry.
You.
Nick.
It's only been 9 years.
Muyo. Yeah. Any other discussion? If not, all in favor?
Aye.
Aye. All right.
Mr. Chair, before we go to the next item, I just wanted to let you know I failed to remind myself on my audit report that I asked Cheryl, and she has an update to you for you board on the CalPERS defined benefit plans. I was wondering if she can provide you board with that update before we move to the next item.
Sure.
Okay, thanks.
Welcome, Cheryl.
Hi, everyone. Cheryl Parkman, Office of Employee Relations. Just wanted to provide an update on providing a CalPERS benefit to our professional investment staff in the Office of Retirement Services. On March 17th, we will be bringing a resolution of intention to amend the city's CalPERS contract to City Council. That is the first step in the process that CalPERS has laid out for us. Once we're able to have that resolution approved by City Council, we will be moving forward with then the final approval of the contract amendment and changing the city's municipal code to allow these employees to be excluded from the Tier 3 benefit and then included into this CalPERS defined benefit plan. So right now we are aiming for a final deadline of mid-May. So that way they can be enrolled into the CalPERS benefits at that time. And I'll be coming back to your board next month to provide you with an update on that. But please look out for that March 17th council meeting, and I'll be sending that memo once finalized to Roberto for distribution.
And you don't foresee any issues going through City Council on this stuff?
At this time, we have not heard anything from any of the city council members, but I don't know if that agenda packet has been released.
Okay.
But in that event, we'll proceed with answering any questions that the council members may have.
Thank you, Cheryl, for the update. Any questions?
Thank you.
No? All right, thank you. All right, so we'll go ahead and go to 4D, discussion and action on extending the term date for agreement between the Boards of Administration and LRWL Siegel.
Yes, Barbara Heyman, Deputy Director, ORS. This memo is requesting approval to extend the term of the existing agreement for Eller Wexler at no additional cost to June 30th, 2020. And it's to allow for any residual work that may be left after the existing term date of March 31st. It'll also allow for Sue to come back to the Audit Committee in May 2020 to give the final update for the closeout of the project.
So we're that close, being all done?
We're absolutely that close.
Absolutely.
Don't jinx it, dude.
Sorry. Okay. So we need to approve the, okay, motion approved by Votto, second by Muyo.
Mio, yeah.
All in favor?
Aye.
Aye, all right. Let's go to 4E, discussion on potential topics, date, and locations for the 2020 board retreat.
Mr. Chair, I just wanted to remind you, the reason we attached the minutes from your last board retreat was mostly to remind you, board, what was the item that you discussed at your last retreat. I wish we would have attached the same for retreats in prior years, but I can tell you that over the last few years, this board has concentrated on dealing with investment-related issues. Now, with that said, I'll turn it back to the chair so that you can have a discussion with the trustees on what topics of discussion we should entertain for the next board retreat.
Thank you. Yeah, so the last 3 board meetings or retreats we've had has pretty much been focused on investments, asset allocation. We had one of the retreats focused on Chiron and actuarial stuff. And that all led up to, one our new asset allocation that, Prabhu brought forward about a year ago. And then also, trying to figure out what our discount rate and the risk tolerance of our sponsor. With that said, we are looking for any topics. It doesn't have to be financially related if we didn't want to. If we go, down more on the administrative side. But right now, we're just looking for ideas of things that, we can't discuss here in a board meeting because it might take a little bit longer to flesh out. We can also frame it where we have, guest speakers, or it could just be, the group of us, having, informal discussions.
Well, let me go ahead and open it up, because I've got the easy part of this, which would be if we decide to sort of keep going the vein we've been going, then the next logical meeting has 2 pieces to it. One is the piece that Harvey's been working on off and on. We went to Harvey a couple of years ago and said, so Harvey, one way we can deal with this risk the actuary keeps pointing out is to lower our discount rate, lower the risk in the portfolio. And Harvey said, well, there's got to be other ways. And since then, you guys have heard Harvey say off and on, there are people that will buy the pension fund and manage it. There are insurance companies that will do that. That's another way to fob off risk. Now, I know, Harvey, you talked to the folks off and on about that. So maybe some presentation from some folks would be good. I said there are 2 pieces. The other piece is, as you said, Andrew, we've spent these last couple of retreats saying, well, how do we set discount rate related to assets? But of course, that equation has a second piece. And logically, from my perspective, driving those offsites, when I was chairman, there's a piece about liabilities. And interestingly, the 2 pieces perfectly dovetail. I'm not suggesting this is what we should do for the offsite, but if the offsite is in line with the other ones, it will turn out, I think, historically, and we've never done this analysis, be good for the offsite, that we're lousy at forecasting liabilities. We may be lousy at forecasting assets too, and that analysis should be done. I think part of what we've done is say, well, how should we deal with assets going forward? And so to some extent, we might say, well, it doesn't make sense to sort of get an insurance company to help us. But I think if it turns out we're lousy and we always under-forecast liabilities, then to the extent that we would ever analyze having an insurance company buy part of the pension fund and manage it, actually, honestly, grappling with future liabilities is really important. So I'm sorry, that was kind of a long-winded explanation. But that would sort of be the next logical step if we were to choose to do an offsite like that. And if we did, I'd be happy to keep rolling up my sleeves. I'm sure everybody else on the board would too. It's actually a really interesting topic.
Santos?
Well, to continue at the Hayes Mansion instead of Hawaii. No, on a serious note, I like what Drew said. And what I'd like to see, and again, this is not a meet and confer process, so don't jump the gun, everybody, when I say this, just how I feel about it. When I invited Harvey over to the water district, we had all the unions and bargaining people there, board members and so on, and it was an educational. And I would really like to see, for me personally, the retirees, Local 230, POA, and we all sit down, not to meet and confer, an education thing, liabilities for the future, where we're going, so everybody can have the same understanding. And I think it's an education for all those folks. At the same time, how do we get together and do better for the future? But if you don't have an understanding, meet and confer is gonna be an adversarial process, and that causes Measure Bs for the future and all this other things. So I really think that would be a healthy one. And again, when I was invited Harvey, and since then, he just sent me a whole bunch of more information that I'm able to share. And this is the first time our board director said, you know what? I really didn't understand this, but I do now. And it just helps. So that's just what I'm.
All right, thank you. Another topic to throw out is trying to address Tier 2. You know, how do we approach Tier 2 versus Tier 1? You know, it's a different buckets from the investment perspective, but, you know, trying to think about that. And we can also, you know, take it one step further and, you know, should our pension plan be different than the healthcare plan? But those are some ideas. Any other? So historically, we've always done it sometime in the spring, late spring, early summertime. We don't have a set deadline. There's no urgency to, you know, do it next month, June. We can always do it after the July break. So what we'll do is we'll continue to solicit some ideas. We'll get a survey out there to figure out what you guys preference would be, and we'll for topics and also what month people would prefer to have it in, and then we'll just start digging from there, and we'll come back to the group with what we're looking at and get feedback. Any questions?
Comment?
Yeah.
Just from a purely logistic standpoint, if you're thinking about having outside speakers come in, we should really set the date sufficiently in advance so that people can schedule that sort of thing. Otherwise, it's not just for us. That sort of thing. And if I may add another comment, what Drew was commenting about my observations, I've started focusing for this fund and for many other funds. I've started thinking about de-risking because, you know, we've classically, year in and year out, the actuary comes in and presents to us the water tank, and it's got some valves on it. And we're constantly told this is a closed vessel, and we get to turn 4 valves. Okay, the contributions and whatever they are, the contributions and the investment income and the expenses, and that's it. And that's all we get. And from my point of view, it seems to me that there must be more. We have to think outside the tank, if you will, because quite honestly, in many instances, that closed system is not going to work. And you look at what the markets did today, again, it's going to keep bouncing around. But if we have another 20% correction in the markets like we did in 07, 08, it ain't going to happen. I don't care how many times you turn those knobs. So I'm starting to focus our attention as fiduciary counsel on other approaches to de-risking the plan, de-risking for us as trustees and also for the plan sponsors, because we talk about what is the city's risk tolerance, what is the risk tolerance, but that is a serious question. And are there other methods that we can promote? We can't get into benefit design, but this board can help promote other approaches, I think, to de-risking the plan for our members so that we don't have members who come here and say, I don't want you going down the road of ESG, sustainable investing, because all I care about is my monthly check coming in. Those shouldn't be counterproductive, and they shouldn't be working against each other. So that's why I've started wanting to focus some board time and attention to other alternatives than just the 4 valves that we're told by the actuaries is all that we get to play with. I think there has to be more in terms of how to approach the sound funding on an actuarial basis of public defined benefit plans. So that's my comment.
Thank you.
Mr. Chair, other examples that what other people are doing? I mean,
There are a number of examples, and I gave Dick a series. I mean, you know, in the last 10 years, almost every state in the union has taken various methodologies at it. But I think we need to expand our vision. I think we need to look at what's going on in the private sector, for example. There are approaches, annuitization is one approach in the private sector with ERISA plans. There's also buybacks. There have been some buybacks of COLA, for example, in systems like this, where a locked-in 3% COLA was promised regardless of the cost of living increases, and the possibility of monetizing that liability and putting money in the hands of members. So I think there are a number of approaches to think about, but I think we need to get outside that closed tank, if you will, and start getting a little more imaginative in the public sector. And I'd like to encourage the board to go that way.
To help prevent another Measure B or other methods of doing things.
Right.
I think it's very wise to consider that.
Are there any more conversations on that topic? Thank you.
Oh, you're in
Har-
charge
Yeah, yay, at the White House now, in words of the immortal Alexander Haig, yeah. Thank you, Harvey. I know you've been working with not just us, but a lot of systems, and I think it's a really worthy endeavor.
Mr. Vice Chair, before we go to the next
Yeah, go
item,
ahead.
I just wanted to say, well, first of all, I agree with council. I was going to mention about making sure that we schedule this early on so that we have time to get consultants to agree to the date. But also, it was more for staff to make sure that we understood what the direction was.
Yeah.
It sounded to me like what it was said was that a survey will be sent out, which means we staff will be sending out a survey of location.
Yeah, isn't that what we did last time?
Yeah, but I mean, but I wanted to make sure that it was understood.
Yeah.
And ask for topics and come back to your board meeting in April with that information.
Yeah.
Is that right?
Yeah.
Okay, I just want to make sure that we're clear. Okay.
Yeah, so take the topic ideas that we got, the people offered up.
Okay.
Figure out, you know, what people would like to hear or talk about, and then we'll bring back the results and we go from there.
Thank you, Mr. Chair.
All right, so if there's no other discussion on that, we'll go to 4F, discussion on potential topics for the joint meeting of the boards and city council.
Mr. Chair, once again, what we did there was, initially when this item was scheduled, we didn't have a date. I just got the date, I think this week, and Cheryl is in the audience, and she can, if you have any specific questions about other issues, she can probably try to address them, but what I did was, we provided you with the agendas for the last two joint meetings so that you could see what were the items or topics of discussion over the last two meetings. The reason, the reason for the item to be here, it was actually twofold. It was to request potential timelines and dates and topics of discussion. As you can see, the city council has suggested April 13, right here between 1:30 and 4 o'clock. So the first question will be whether the majority of you board members are available that day to attend the meeting. And if that's the case, I will pass that information along to the city council. And then the second question is, again, based on the agenda that we included for the item discussion, what kind of topics are you considering that we should be addressed at this joint meeting, which I'm sure both of you boards will have some comments. I'm sure the city council will have some input, and then Cheryl and I will get together and hopefully come up with, based on those topics of suggestion, then we'll come up with an item, with a meeting, probably 2 or 3 topics for the joint meeting. So just wanted to kind of set the base, and I'll turn it over to you.
Okay. In regards to topics, one that I wouldn't mind hearing about is the mayor has this task force that's been going on for 4 or 5 months now. I'm not quite sure what those conversations are going and how productive it is. I would like to get some type of feedback or report out of how those discussions are going, and just see what ideas are coming up.
Andrew, that's one thing I was going to throw out as well, is an update from the working group, task force, the retirement working group. We haven't really come to any conclusions yet, but, and I think we have a couple more meetings. But this would be a good opportunity to update both the trustees, but also the council as to what the working group has been discussing and options we've thrown out and discussed and things we've discounted or not considered viable at this point. But I think that would be a good update for a good discussion for us.
Okay. Any other ideas? All right.
Well, okay, I'll throw this out too then. We had a real robust conversation around social investments, the ESG proposal, or EGS, I forgot the initials, thank you. So that might be something that the joint board, the joint meeting would be valuable for the council to listen to as well, particularly in light of their declaration of climate emergency and their request that the boards consider divesting from fossil fuel investments, but to understand what the impact that might be. So to have some sort of presentation around that. And then, of course, the council will probably want to hear about unfunded liabilities and risk and that sort of thing. But that's something I think we always talk about. Is that microphone even working?
Okay. Any other topics?
You know you have more. Come
Just my opinion. That's three. We don't want it to last all day.
Yep. Since it's same day as city council. No, is it?
No, it's actually the same
a
day
Monday.
as the next working solution group meeting. So if you have the time, after you join meeting, you can stay with the audience and watch for 2 more hours the discussion on the retirement working group.
At the same time as Bonanza.
What about the date? So April 13th, it's a Monday, the day after Easter. Are people going to be in town? Are they going to be out, family, spring break type of
Ooh,
thing?
it's spring break for some people.
Yeah.
Not for me, but it is spring break.
You're not going to be around. Anybody else have conflict that, so we at least
I'll be there.
be there? Okay, so potentially 1 or 2 people will be missing. Hi, Cheryl.
I just wanted to provide some context around that particular date.
Okay.
City Council typically schedules out several study session dates for the 6 months of the year. April 13th was one of the study session dates that was available, and in fact, the only one available in this particular 6 months of the year. So we know that all of City Council would be available on that date. It also is of particular interest to us because it's not a Tuesday, so we wouldn't have to interrupt a regular council meeting to have it on that date. So just wanted to provide that context in case that helps people with any scheduling conflicts.
And how soon do you guys need, I probably sooner the better that you know the date, right? So, I mean,
Absolutely, because if we do need to change the date, we would probably need to look at a city council date.
Okay.
And the May city council dates, a lot of them are taken up with some budgetary items. So we would love to know as soon as possible if that would work for the majority of the board members.
You mentioned there were other study session days that you guys were looking at. Are those dates available, or right now it's April 13th that you guys are solely want to focus on, or is there like 3 days that we could choose from?
Unfortunately, that was the only available date. The other study session dates were taken in the last month that we tried to schedule this.
They're all related to the budget.
Yeah.
A lot of them are,
Yeah.
that's correct.
Okay. Okay. So, sounds like there's only like 1 or 2 people that would not be able to make it. We could provide that feedback. All right, Roberto, back to.
Yes. Yeah, I mean, so the day hopefully won't change, but we still have to wait for the February meeting.
Okay.
And see the availability of the trustees. I'm guessing that if the bulk of both boards trustees are available, we may move ahead with that date.
Okay.
But then the issue would be topics. I think Councilmember Foley suggested 2 very good topics. But it's always helpful to hear from the board members on what you may be thinking about.
Okay. Well, if anybody else comes with any other topics between now and then, go ahead and email Roberto so he could pass on the information.
Thank you.
So, all right. On to 4G, discussion and action on committee assignments. So there were two items that here that we wanted to discuss. One of them is that we do not currently have a board or a chair for the governance committee. And as I pull that up, if I remember correctly, we got Nick, Vince, and I think Dix sits on it with Franco as an alternate. Yep, there it is. So I went ahead and I reached out to Nick to see if he would be willing to chair it. My thinking behind it was looking at the other people on it. Dick is chair already of the disability committee. Vince just got elected chair of the JPC last week, 2 weeks ago. And so I reached out to Nick, and Nick said he would be happy to serve. So I'm not sure if anybody else has any questions or objects to it.
Excellent decision. Let's move on. Good.
Thanks, Mick. Yeah. And the other item is we do have a new trustee that came on board, and we need to find a spot for him into one of the committees. But we, after talking to Drew, it's probably best if we just wait for him to be here for a meeting or two. Let him get his feet wet first, and then we'll find a committee that will work best for everybody. So other than that, we are done with that topic. So on to 4H, discussion and action regarding the excused absence of trustee Oswald from December 5th, 2020, January 9th, and February 6th. There is no longer any action that needs to be taken about on this topic. If you guys read the memo, there's excused absences and unexcused absences. Since this memo came out, they are all converted to excused, and so there's really no discussion or discussion that needs to be done unless someone has a comment.
Just point of order, I would just say for the record that you're actually meaning December 5th, 2019, not December 15th, 2020.
Thank you for that correction. Absolutely. So if we could make that one correction, December 5th, 2019, January 9th, 2020, and February 6th, 2020.
Do you mean trustee Bancas hasn't been absent to the meeting that hasn't happened yet?
No, so.
Okay, all right. All right, no, just want to make sure.
Yes. So, all right, let's move on to.
Mr. Chair, before we move to
Yep.
retirements, staff just reminded me that I don't think there was an actual vote on the committee assignments. So you
Okay.
actually, the board actually have to vote to propose that Mr., I'm sorry, what's your last name now? Mayo?
Mio?
Sinceri.
Sinceri. Is appointed the chair.
That was part of the agreement. If he was chair, we're not going to make it official.
Oh, is, okay.
No, just kidding.
Hey, and I believe you.
Motion to approve.
Motion by Santos.
Or is it a nomination?
No, this is to approve.
Approve. Okay, so approval by Santos for Nick Muyo to become chair of the governance committee. We got a second by Drew Lanza. All in favor? Aye. Aye. Thank you, staff. So on to retirements, service retirement. Stephen T. Guyana, sorry if I pronounced that wrong, Police Sergeant, Police Department, effective January 25th, 2020, with 32.18 years of service with reciprocity. Can I have a motion to approve?
So moved.
Second.
Motion by Santos, second by Nick Muyo. All in favor?
Aye.
Aye. Nick, did you know him by any chance?
I knew him. I didn't know him well. I know he had some prior time, so good man. We'll miss him. I'm surprised this month we've only got one retirement. When's the last time that happened?
Cola's happened.
I guess, yeah.
Franco, you have any comments or?
Congratulations on your retirement.
All right, so we do have a few death and survivorship notifications. Notification of death of Lawrence Demkowski, police sergeant, retired January 10th, 1990, died December 20th, 2019. Survivor benefits to Rita Demkowski, spouse. Notification of death of Gaylord Lane, fire engineer, retired August 28th, 1983, died December 21st, 2019. No survivorship benefits. Notification of the death of John Martirano, police officer, retired June 3rd, 2006, died January 3rd, 2020. Survivorship benefits to Susan Martirano, spouse. Notification of the death of Edmund Oizeth, police officer, retired October 30th, 1999, died January 9th, 2020. No survivorship benefits. Notification of death of Mervyn Pierce, police officer, retired August 5th, 1992, died January 1st, 2020. Survivorship benefits to Margaret Pierce, spouse. Notification of the death of Randall Sutton, fire engineer, retired November 6, 1991, died January 24th, 2020. Survivorship benefits to Jennifer Sutton, spouse. At this time, can we take a moment of silence? Well, thank you. Condolences to the family. Thank you, everybody, for their services that you put forth, to the city and to the community. Anybody have any feedback?
Please go first.
Well, yeah, I'll defer to Dick for the firefighters. It's always sad when we lose members, police and fire. But as I look at this list, there are just a lot of nice guys on this list. I mean, these were they were all good cops, but they're just some nice guys. It's really sorry to see them pass along. And as you said, our condolences to their family and friends. Thank you.
Thank you, Nick.
Yeah, Gaylord Lane was a treasurer of Local 230. Randy Sutton and myself came on together. And like Nick said, it's really tough. Good people, and they did a good job. The best of their families.
Thank you for those comments. All right, committee, 7.1, investment committee. Nothing to report out? Nope. All right, next meeting is end of this month? All right. Nothing to receive and file for there. Audit committee, any oral update, any from the chair? Anything, Vado?
There's only a couple items due to time. I'll just cover them briefly. Most of this was old business, but we did have the city auditor come in with some recommendations, kind of an evaluation on how benefits were paid. And I'm pulling up the document here. I think for the most part, it was a very good report card. The only, let's see here.
Let me see if I can.
You might be able to do this quicker than me, Roberto.
So a couple of things. On item D, update of the city auditor recommendations to the Office of Retirement Services. That is if you recall, that is based on the audit by the city auditor 2 years ago, for which we created a matrix. And the recommendations are 25 of them, 20 for ORS and 5 for the city. And then we colored them depending on where we are in the process. Green is completed, yellow, partially implemented, and red, we haven't even started. The reason that's there, you have 4 new updates. So in reference to item number 5 was updated, we had a difference of opinion with the city auditor. We felt from the office that it had been implemented fully. They kept indicating it was partially implemented. And so we finally settled. And let me tell you, this has to do with the budget process. And the big hang-up was, you may recall, there is a difference in opinion on the definition of what comprise an administrative budget. You remember from your general counsel, you receive an analysis that clearly indicates that investment expenses are not part of the mandatory budget. The city received an analysis from the city attorney indicating otherwise. So the compromise with the city auditor was that we do have a budget policy and procedures document. It's attached. Actually, it's attached in the governance committee discussion later today. But if we just basically state that the difference of opinion between the city attorney and the city and the general counsel in the budget policy, that would be sufficient to call the recommendation fully implemented. So you're going to see today in the governance committee discussion later this afternoon that document with that additional language, which will then make this number 5 fully implemented. Number 24 was updated to be partly implemented. Number 19 was updated to indicate complete because we did provide those policies to the city council when Prabhu presented the fees back in September of 2019. And we also updated number 23 to account for the fact that we already started the process of issuing newsletters. So those are the 4 main items that were updated, and that's what you see in that matrix. That's D.
That's D.
E is the update on the pension administration system. It's a drafted document with a presentation. You cannot tell, but Barbara is here and excited to speak to it if you have any questions. Suffice to say that the project was completed. There are some issues, namely member portal, that we're still working through it, and you have been kept apprised on the letters that went out to first to retirees and eventually to active members to sign up for the member portal. And then, of course, some areas of the pension administration system that are related to Measure F, that, of course, they were not part of the initial project, but because of Measure F, they were added, and so we're still working through that implementation. But for the most part, the project is almost completed, which is the reason why we extended the contract today. No dollar-related increases, but just the timing in the event that our consulting firm needs to do more work with us for the last 3 months of the fiscal year ending on June 30th. But I'm sure if you have any question about the memo or specific about the project, Barbara will be happy to address them. And then on items F and G, what I wanted to share with you was number 1, I don't know if you are, but I'm very excited with our new senior auditor. And the bottom line is twofold. Number 1, we're still on track to finish the rest of the audit projects based on the previously approved 5-year internal audit plan. Of course, we always stand ready to do reevaluations of the plan in case something comes along that requires that we have to reassess the risk or the process and change the order or add another audit that we had not initially thought about. But today, the plan, the 5-year plan, is actually on track. The 2 audits that were related to the benefit disbursements and cash disbursement process, just the summary of it is that, of course, there were some findings, but generally speaking, the office is observing good practices in administering the benefits and cash payments to the members. There are appropriate segregation of duties. The level of review is thorough enough, and there is proper and adequate documentation. So if you have any specific questions about the audits and the reports that are there, I'm happy to address them. But that, Mr. Chair, completes the comments on D, E, F, and G.
And G. Any questions for Roberto on any of those topics? If not, let's go back, and we need to receive and file 7.2B, C, D, E, and F, and G.
Yeah, on C, I just want to mention that's your quarterly travel and attendance report prepared by Linda, and if you have any questions or even changes, let us know, but it's there for your reference.
Okay. And before we go any further, just want to remind, at 1 o'clock, we will have to take a 5-minute pause for the media to switch over. So we'll continue the meeting until 1 o'clock, and then we'll have to do a hard stop and continue that conversation at 1:05. So on to 7.3, governance. Any oral update? Chair? You got a meeting after this,
Yeah,
right?
I wasn't chair last time, but we do have a meeting today. The,
After the pause.
yeah, I
Yeah.
think the only thing that really needs to be addressed here is the discussion about the recommendation to deny the purchase of access to Chiron's educational tools for one trustee. I think that the position of those voting members at the time was known, but we elected to defer out of courtesy to Vikash in case he wanted to make his case or make a
Yeah.
pitch here today. So
Okay.
I'll open the floor to him if he wants to.
Yeah, and you know what, before we jump to you real quick, just to paint a picture
Sure.
of how we got to where we are. So it was back in October, Vikas, at the very end, threw out a suggestion. It came to the November board meeting, and the suggestion was to be able to get access to a training tool from Chiron for all the trustees. Bill Harmark from Chiron was here in the November meeting. He spoke a little bit about it, talked about the cost that associated to it, which the cost was a $5,000 setup fee, and then an annual fee of $2,000 or $500 quarterly. Based on those discussions in November, we realized the way it was worded on the agenda, we could not take any action on it. So it got pushed to December. We were missing some parties, some trustees, so we decided to defer it. Went to the governance committee. They missing some people, so it came here. And so here we are today to have this discussion. We wanted to have the discussion with Vikas present because he has some very strong arguments and he needs to be involved in this discussion. So Vikas, do you want to
Sure.
talk about it?
Absolutely. You know, to me, it's a very straightforward purchase. It's an educational tool. I think one of the fundamental pillars for this board as we do our jobs is to understand what the actuaries do. And the other part, of course, is investment returns and risks. And I think we all have different levels of understanding of what actuaries do, what the details are. I think for us to do a good job of oversight, we need to be as informed as we can be. And I think part of the charter for trustees is being educated, and we encourage that. In fact, in this meeting, there's some consent calendar, includes 2 items for travel, which includes conferences, education. One of the tools for education is webinars, and I think we have at least 3 trustees who could use this kind of tool. We have a new trustee that hasn't joined. We have Trustee Menon, and then myself, who are curious to understand better the details on what moving various levers on the actual assumptions does. Now, if you look also in the consent calendar, there's a report from Cortex that lists about, in 54 pages, 87 educational opportunities. Now, if any trustee came in with a request to travel to these conferences, to go to any education, to take a webinar, it would actually be in the consent calendar. We wouldn't even discuss it. And if you look at the costs on some of those educational opportunities, they range from a few thousand, which, by the way, many trustees in the past have availed themselves of in terms of travel and the registration fees. And also, in this list of 87 opportunities that's in the Cortex report this month, some of them range in cost up to $11,300, so which we would routinely approve. And I think we have an obligation to support the education of the newer trustees. We have 3, we have a third of the board that could actually use it. And there's no compulsion on anyone else using it or not using it, but those that ever want to have an understanding of the actuarial assumptions, the levers of this plan, that's a nice tool. When we go out to education in general, we learn about these concepts, I would say, in the abstract. But this tool is for this plan. I think it's a very straightforward tool to purchase. Although it was phrased as a one trustee item, I think many trustees can benefit from it. Certainly, I can think of the third of the board that can benefit from it. So that's it. So I would probably move for the board to approve this.
I'll second that motion. I think we're entering an era where we're going to break through that opaque wall that the actuaries have deliberately built around themselves. We talked this maybe at the offsite and saying, well, so how have we done in forecasting liabilities? And as I've reached out to Chiron, they are amenable but not eager. And so I think that behooves us to educate ourselves and to sort of take the steps. I've said I'll fly up to Portland for a day or two for meetings with them. So I'm supportive of this. I'll second the motion.
So the second, so the other hand of this discussion is, it's an educational tool, but part of it has to be someone has to educate us on how to use it, how to interpret the data. And, I see that's, it's one of the reasons why we have consultants is to educate us on that. The educational part, the argument that you've made in regards to comparing it to everything in the core text, that 58 plus pages of training opportunities, that it's a very, very compelling, very compelling. My only concern for me is, are we overstepping our bounds in trying to manipulate numbers that we don't quite understand, that we have to hire a professional consultant to interpret for us? That's where it's the gray area for me. But then you always raise up the question, okay, how do we know if their information that they're providing is accurate? How do we know their data points are accurate? And I believe every 4 years, I don't know, Roberto, staff could remind me, something around every 4 years, we hire another actuary to audit.
Every 5 years.
Is it every 5 years?
Yes.
So we hire, and I believe it was Siegel last time.
Yes.
They audited Chiron. And they came back and they said everything was in line with industry norms. There's nothing that's outstanding that they would need to address, and it was a very clean report. So this is a tough one. This is a tough one. I'm on the fence. I'm leaning towards not approving it just because because I think we're overstepping our bounds between what is the consultant's job versus versus us trying to be educated to make informed decisions.
Let me just real quick respond to that. I mean, so I've interacted with Chiron and asked them to do just that. And I think their response is in line with what you're saying. They're saying, well, that might help you, Drew. It might help one or two other trustees. But it's not what we do for other clients, and it's not generally what's done. But then I pivot back to what Harvey said earlier, which is there's this vessel and these four knobs. Well, no, there's not. And I think the sooner we continue to pursue that, the better. This may be a fool's errand. You may use the tool and say, we just blew some money and I didn't really learn anything. But of course, whenever you use a tool and don't learn something, you learn something.
Yeah, go ahead.
Correct me if I'm wrong, I think Siegel used to be our consultant, and they left. And I remember we used to question them. So I applaud you for trying to think out of the box.
Yeah.
And if we're gonna second guess whatever we have, so be it. I look forward to it, and it helps educate me to be sharper. So I'm all for it.
I wasn't on the fence. I was actually on the no side. But the one thing that I've learned in the several months that we've worked together is that Vigash is always thoughtful, he's always contemplative, and he always asks really good questions. And you made a very good point today. And I'm happy to come off of the fence and support this. Maybe with the caveat that we revisit it in a year,
Yeah.
and you report back to us, and I know you'll be objective about what you learn or don't learn, and see if it's something that's worthwhile, and we have an opportunity at that point to either continue it or to discontinue it. So I'm happy to support you, Vigash.
Franco and then Eswar.
I just want to say, having seen the tool and talked to them at certain conferences, the tool's really just a calculator, but there's a brain behind the calculator, and that's our actuarial formulas. So if somehow you think if you plug in that the city hires more people, or we make a change to the discount rate, that's going to change something, then, great for you, but those are decisions made amongst this board and through the city. So without knowing the formulas, the mortality rates, you know, average age and everything else, I don't see personally how the calculator is going to help you other than to go, well, if the city of San Jose put more money, you know, into infrastructure and less money into public safety, and public safety went down, and, you know, the average age went up, this is what we could look at later. But those aren't things that we have any control over. So I just don't think I think it might actually confuse people more, personally.
Ezra?
Yeah, I mean, like I said before, I mean, Nick said, let's try it for a year. I think if we learn something, it's not a big cost relative to everything else that we're spending. And it's an important part of what we do in trying to assess, you know, is there money for our retirees?
Okay. So, sorry, we got to take a break. I didn't pay attention to the clock. It's 1:03.
Trip to Tahiti.
If you're going to vote on it, you can vote on it. Or you have to wait?
He just peeked in.
Okay.
So, sorry, we're going to hold this conversation for a few minutes.
Okay.
Sorry about that.
I was talking to the professor, and it's like, this is not, we've never done this. There was Right, so, gotta. You know, now, some. So, and those three things combined mean.
All right. Are we ready now?
We are. So, we're missing. They're missing a few.
And, you know, there are few. That's why we were, as begs the. Base. Come on. They don't.
This is not very short.
Especially some of the if they do a modified antiviral, kinda like,
Yeah, that might be a good interim step.
yeah, but you know, it's all about slowing it down.
Yeah, yeah,
Don't interact as much,
Yeah.
right? Take the, you know, it's funny, I sent a note to all my good friends who, sort of I'm the smart guy in the crowd, right?
Yeah.
And I told them, I said, I'm gonna go to the Sunday, say, this is your mom talking. Sleep, exercise, diet, you can boost your immune system. Well, no, you don't get enough sleep. If you're under stress, your immune system is, they were like, you kidding me? I'm like, what else can you do, right?
All right. Who are we looking for? For Santos?
We approved our Tahiti budget.
Yeah,
Well, Sam, there.
No, that's Nick.
Oh, that's Sam, you're
That's
right.
Mio. That's
Mio.
Mio.
You're never gonna live that down.
To kick around much longer. Oh, we'll still kick you.
Yeah, right.
I just won't be here to enjoy it.
If we won't be here, we'll still kick you. Yeah, but we have no vote.
1, 2, 3, 4, 5. You got a quorum, you can.
Yeah, but you got
Yeah,
no vote.
I want
quorum.
everybody here.
That's right. That's right.
maybe Andrew, I can also add a few more reasons why maybe Franco might consider moving from the fence.
Oh, I know Franco.
Franco's had him play with that tool a lot.
Yeah.
You know, like those examples on how the experts, they make error mistakes.
Who was it you missing?
We're missing
Jay?
Esmar and Dick.
Yeah, they'll be back.
Baxter, yes.
All right.
Well, you were doing so well, and today, Vince is coming for the committee meeting. He said you'd be surprised. The chair is running a very long meeting today. I don't know what's going on. Oh yeah, it's not gonna be good. Not gonna be helpful.
Yeah, it will be done, but. I think I ran one once till like 3. Before the.
Oh, that's why when we had the meeting.
And it was a real meeting too, like, you know, it's like, it's 3 o'clock, that's it. Plus they're doing the FLSA thing,
Yes.
2 hours.
All right, I apologize for that abrupt stop. I completely missed the 1 o'clock deadline, so apologies to that. We were almost about to conclude on 7.3B. And Vikas, you want to make a motion? You officially? He seconded it.
Yeah.
Do you want, are you willing to entertain his amendment? Do you
Yeah.
have the amendment of a 1 year to review?
Yeah, absolutely.
Seconder will, accept the amendment.
Okay. So, the motion is to approve with a 1 year commitment to reevaluate, the educational tool. We got a second, that was by, Vikas, second by Drew Lanza. All in favor for this?
Aye.
Anybody opposed?
Oh, you said aye?
Oh,
Okay, one opposed.
Smiling Dan in the back there.
Should we add one more vote?
No, let him have his lunch in peace.
All right, so that motion passes 6-1. All right, so let's move on to 7.4, disability Committee. Santos, any report out?
No, we had, the next meeting will be March 9th at 10 o'clock. We had the last meeting here, whatever it was, and we had the very healthy discussion with listening to Dr. Tierman's report and the new process. First time we went through it, and good input from Berto, all the committee, and Drew Alonzo. And it was, since it was a board process, bring it back to the board for discussion.
All right, thank you.
Drew, why don't you add to that, please?
Yeah, I mean, we've got Dr. Tierman's suggestion there, 7.4D, and Dick and I were not entirely sure if we had enough authority on the committee to approve that, so I think we'd sort of like the board to nod their heads up and down and say, sure. Real quick history on that, what Dick was saying. This board delegated some of its, well, not authority, this board delegated the committee to hear the cases, put them on the consent calendar. But the board said, yeah, if you change the procedure, I'll give us a buzz. And we really haven't changed the procedure in the last couple of years, because the city said, look, we want to redo and have a whole thing here. But God bless Dr. Tierman, like Dick said, she's down there and she's saying, hey, would you guys mind making this tweak to the process? Because I'm doing all this work, and sometimes it goes then to the committee, and we go, oh yeah, that's a slam dunk. She's like, well, I just spent 10 hours, and probably 1 hour of that I could have gotten you to slam dunk. So I don't know whether the board does need to vote on this, but it can't hurt, right? It's 7.4D.
So let me just say a couple of things. Number one, I believe Dr. Tiemann and Ross are both on the phone in case your board has any questions, if you had a chance to read the memo. So Ross and Dr. Tiemann, are you both there on the phone?
Yes, hi.
Okay, very good. Number two, this item specifically is related to the fact that Dr. Tiemann was actually drafting her medical advisor report, and after it was available, and of course, share with the applicant and his or her attorney, and they will see that the decision by the medical advisor was not to support the disability, then they will just sort of then go back and say, well, wait, I'm going to go back to IME and have them do further work so they can address a specific issue so they can come back before the committee. And so it happened often enough, especially the last, I would say, year or two, that Dr. Tierman had raised this issue with us, which is the reason why it came to the committee. And that's why you are here now this afternoon, looking at the memo by Dr. Tierman. The recommendation by the committee was to approve the process as stated in the memorandum. And the reason this is before you is because it just makes the process less efficient, right? She writes to her memo, and then you have the chance to then take a look at it and ask UIME to address a particular issue. Then she's spending more time on the process than she should. And I reminded the committee, part of our responsibility is to make sure that we have an effective but also efficient process. And so I'm going to share with you my comments that I made to the committee at that time. Number one, let me just be completely clear on this issue. I'm all for making sure that we perform an effective process and the applicant gets all the chance to be dealt with by the committee and this board the appropriate way in terms of determining the disability or not. Having said that, the reason I have a bit of an issue with this particular approach is because if I'm an applicant, I have an attorney, it is your responsibility with the attorney to make sure that you provide all the evidence that support your application. Everything. You exhaust everything you have to do, provide the evidence. The medical advisor issued her report, and it has been my experience in other jobs that I have in this particular issue. Then you come to the committee or to the board and you address the issue. Either you have enough evidence to support the request in front of the committee of the board, and the committee of the board decides to not take the medical advisor's input, but then go with the evidence provided by the attorney and the applicant, or go with the medical advisor, or what has been happening, which is we allow the member to go back and then have the IME reissue the report addressing the particulars of the doctor's report. So because of that approach, was creating longer time frame, more cost. They created this where I believe now it calls for a 6 month, right? A 6 month time frame extension before the items go in front of the committee again. But my point with that is, even after that, the doctor already issued her report. Am I right, Dr. Tierman?
Yes.
And so you still have the same situation. It's going to come back, and then, she's going to have to spend more time issuing the report. I guess my point here is either you let the committee make that determination without having to go to the 6 month, or, and then they can make a determination, yes, it's going to be approved, no, it's not going to be. Or I guess if it's a committee, all it's going to do all the time is go ahead and give them the 6 months, then it's a moot point. We might as well implement this process. All I wanted to make clear here this afternoon was my view on the matter. Having said that, I'm all for making sure that the applicants get a fair process, which I think it is. And even with the approach that I'm suggesting, I think it's an appropriate and fair process. Because ultimately, it is the responsibility of the applicant and his or her attorney to provide the evidence to indicate that they are disabled and whether or not they are disabled on a service-connected basis.
So I think, let me just jump in for a jump in. So I think Roberto's making an excellent point they made at the committee meeting. And if I were one of the disability lawyers in the audience, what they'd say to that is, that's great if I can get the damned information, but the medical system is so messed up. I go to doctors and I say, give me the case report. And the doctor says, so, and Roberto's nodding his head saying, so I agree with 100% what you're saying, Roberto, but in reality, anyway, I'm sorry, Harvey.
No, please.
That's good. No,
I'm listening.
That's good. It was very pithy.
We should be going to the well with Dr. Tierman once. And is what I understand is happening, because Dr. Tierman is supposed to be getting the medical files, medical reports, whatever it is, in the package with the application, and then evaluating them and making a recommendation to the committee. And what I understand, if I get this right, because it's kind of a moving target, is I understand what's happening is that Dr. Tierman is doing that with whatever reports that she has, and then when she writes her supposedly one report and recommendation to the board, the applicant's counsel is saying, oh, we disagree if it's a denial. We disagree with that. We want to go and get another doctor's report and bring that in, and then have Dr. Tierman then reevaluate that report, if that's what's going on.
I think very close, except in most cases, that's what I see, Harvey, it's that the treating physician is not going after another doctor. The treating physician says, well, here's half the case file, and Tierman reports on that.
Okay,
And
well, that
then they
burden
say,
is
well, wait a
on-
minute, I had this other surgery. It's,
That burden is on the applicant to come forward. So as I understand, what we're trying to do here is go back to the idea that we only go, once we've wrapped up the package and we present it to Dr. Tierman, that's it. And that recommendation is going to go to the committee, and the committee's going to come back to the board with that. And if that's what the purpose of this is, to make it clear that applicants must have their entire package, whatever they're going to rely on, to us before we send anything to Dr. Tierman, then I think we can implement that. In terms of process, I just want to say, we have a procedure for the Disability Committee that's in writing, and what we need to do is, if this is adopted by the board, amend that procedure to incorporate these changes. And I would say the motion, whoever makes a motion, if there is a motion, would be to direct staff and council to incorporate this recommendation into the existing procedures. Those procedures then go out and are known by the applicant community and anybody else, and we hand those to people, as I understand it, when they come in, when they file an application. But we need one procedural document that outlines what the procedures before the committee and then the board are going to be, as opposed to separate pieces out there that are not part of the process. So I just want to make sure that it gets incorporated into the procedural document. But I take it that's the import of this, is that Dr. Tierman, we go to the well with Dr. Tierman once, not multiple times. Is that the idea?
Well, that is my point. I don't think that this allows for that. I think this actually requires her to issue a report and then allow them another 6 months to see if there's anything they need to. To me, that's not appropriate. I hear and you know, I agree with both the committee members, obviously, in that I think the attorneys will argue, well, we don't always get everything, but I mean, that's not the committee or board's fault. It's their job to get everything they need to get. I mean, the doctor is on the phone. I wonder if you have any questions for her, just to make sure that I'm not explaining this incorrectly.
Let me just jump in real quickly. So here's the problem, right, Harvey, is we do have a process, and the process allows for an appeal to the board. And so we're making sausage down here, and the whole goal of that committee is to be definitive by the time it gets to the board. And so what will happen is doctors will not, the treating physicians will not give the data. Dr. Tierman will do the best she can. We will say, no, there's not enough data, and the applicant will appeal and resubmit to this board. And so what will happen is probably, I don't know, Harvey, maybe 10% of the cases will be heard by the board on appeal with all the data. And so maybe we need to revisit the entire process, right?
But the appeal should
and
not
this is
be
changing over
bringing
time.
new evidence before the board, right? Is that what's happening? That
Yeah.
there's new
Let me-
evidence of medical condition is being submitted?
I don't know whether I would say, go ahead, I don't know whether I'd say new
It
evidence.
should be
I don't
considered on the record before the disability committee.
So I've had a few of the members come to me. They've sent me the reports. I think I've even talked to Dr. Tierman a little bit about this. Here's what's typically happening, and I've had the attorneys talk to me. I've talked to everyone, and believe me, more times than I wanted to. You know, an officer is chasing someone, he jumps a fence, he lands, he hurts his back, he writes it up, it goes to workman's comp approves it, he gets either a surgery or not. Looks like he's not gonna come back. So I mean, I have IME, AME, QME right, but he gets one with his attorney and they go get, let's say it's a AME. And they go, yep, this was injured, he gets this surgery. The surgeon writes up whatever they do. Then they go to the board, they submit their application, the board sends them to an IME. So they've got now two.
Yes.
In some cases, they differ, in some cases, they're the same. Then Dr. Tierman gets the reports, and she'll look at it, and she'll go, but the doctor never considered this degenerative back disease, or this that he would get just based on his age. And then that goes back to the applicant gives it to their attorney, and it goes, well, yeah, the doctor was did a surgery based on an injury, and they fixed the injury. They weren't looking at whether you had a back disease or not. So now they're in this thing that they go back, and they're trying to say, well, could you write up something that says it's not this back disease? And Dr. Tierman, as she said, I was at the meeting, is gonna say, well, there's no new medical evidence, so my decision hasn't changed. So.
How would Dr. Tierman know about this congenital issue?
Wait,
if
can I
it's
say
not in the
something?
medical
You know,
records?
because you are talking about what I do or what I say.
Please.
Why should we be
Basically,
educated?
one of the problems, especially for police and fire, is that most people have what they call cumulative trauma, or have one injury that they say, I bent over or I was lifting a patient up and my back hurt. In the past, there was a belief in medical circles, in the 90s, I was one of them, where they said that osteoarthritis was wear and tear on the back. Now that we have genomes that have been mapped out, we have started to do studies. The original studies on firefighters and police officers were just done on firefighters and police officers. So there's a high percentage of firefighters and police officers that have chronic back pain or all certain things, and every firefighter, every police officer has had some sort of injury. However, when the epidemiological studies went and looked at the working population, there was no difference between degenerative joint disease or changes in the lumbar spine between people who do sedentary work and people who do work, manual labor. There is study after study that shows that. So now we have a workers' comp system that they go through first, where it's presumption for any musculoskeletal injury for police. Most of the time, no one ever questions if a firefighter says they lifted it up. Then they get an MRI scan, and it shows stuff, and the doctor says, aha, it happened from this injury. This is the problem that is happening. There's been change in a medical opinion, and people aren't getting disability retirements because of that, unless I can get some information that shows why this case is different. Usually the case that, I don't know who talked, who said that someone fell down, hurt his leg, hurt his knee. A lot of times, that's straightforward. It's really the backs, the degenerative diseases, that by the time you're 60, 85% of all people have changes on back x-rays. 80 of the total population. And they're finding now running does not cause it. So I can go and give you medical article after medical article. The doctors in the workers' comp system don't understand because we have a different criteria. I could change the criteria, but right now the criteria is real and measurable. And I hope that clarifies it. I need something real. I mean, I don't want to say I need something real. I need something that really shows that someone did something and the direct injury happens because of that. And we're human beings, and people believe that all of their problems happen. I don't know if you've ever met someone who sneezed and got back pain and had a herniated disc.
Yes.
Or someone picked up a piece of paper and got horrible back pain. Do we really think that back pain was caused by picking up a piece of paper? No, it just manifested itself. So I hope I'm clear here in why I wanted to circumvent, give the chance for a physician from the applicant side to give his opinion, so they have both opinions before we go before the disability committee and let the disability committee decide, rather than me keeping on getting, how about this, how about this, how about this? Sometimes I've written 5 rebuttals to rebuttals without it ever being heard before the disability committee. And I hope that's clear, but that's the reason for it. We need to have, just like in a courtroom, there's expert opinions. It's up to the jury to decide which one is more credible.
So just to make sure that we are clear, you will issue your report. The applicant and the attorney will have ideally 6 months, although at times we agree that it may take longer. They'll issue a follow-up report from the IME, QME, or whatever, addressing your particular findings, and then the committee will decide which one they believe.
Exactly.
Okay, all right. So I understand what you're saying. I still think that it is the responsibility of the applicant and the attorney to provide all the evidence they need. But I can certainly understand where you're coming from. So you will not be rewriting what you wrote. You'll stick to what you have, and the committee will get to see both of the reports and they'll make a determination.
Exactly.
Okay.
And if they want more information from me, I'll give it to them. which has happened at times. The disability committee members said, can you see if you can get this or find out about this?
I'm gonna
That
guess,
confuses
I don't wanna speak for the committee, I'll let them speak for themselves, but I'm gonna guess if I'm a committee member and that I get to a point where I'm not clear, I will ask you to, to give me another report to see what you have to say, so that we have some evidence. But having said that, counsel, is it clear now what, oh, I'm sorry, Ross, I was looking at Harvey, but
Other
you're also
counsel, got
counsel.
it.
I apologize, that's good to know. Do you have anything to share with us?
No, I think it's ultimately a policy call, and I think the dimensions of the policy parameters have been sent out rather well.
All right, so I just
It's an
was,
issue of whether we want to put into the process this extended 3 to 6 months additional period to obtain what I'll loosely call rebuttal medical evidence. And certainly Roberto's position is quite reasonable. The policy at this point the proposed policy doesn't follow Roberto's approach, but it certainly could. And that's why I think the issues have been brought to the board.
I can understand how this approach provides further options to the applicant, and that, not saying that it's not reasonable, but I don't want to speak for the board, but I would like to hear what council have to say and what the recommendation from council would be to the board on this particular issue.
I'm not sure, I'm confused, quite frankly. I'm not sure how this differs from current practice, from what's being recommended. I'm not sure how that differs, and I'm just not following.
I think the main issue was that this approach, it make it clear, and they have 6 months, 9 months, depending, and come back with the memo. Before, they will come back with the memo, and then it will go back to the medical advisor, and then she will rewrite a second medical advisor report, and then if it, for whatever reasons, she still was not convinced, they will then ask an IME again, or AME, or whatever, to write something, and then she will write a third one. This one, I think what she's saying, if I understood correctly, is I have my report. They'll get one shot to say, hey, let me address this issue, and then the committee, then it will go to the committee. If I understand correctly, the committee will decide, is it the medical advisor or is it the new further evidence? Which one are they going to use to support the determination? That's what I understand.
If they
You
come
remember,
back-
Harvey, the committee does not make the determination. The board does. It's on the consent calendar. And so our goal is to only put on the consent calendar something that we see as clear, right? In fact, I think in the next board meeting, you're going to hear a case. It's one of those rare times where we kick a case up to you because we couldn't figure it out.
So this isn't just one bite at the apple, then. This is 2 bites at the apple with Dr.
No,
Tierney.
because it only comes to the board once. Oh, to Dr. Chairman.
Oh, it could be 3 or 4, and it's never heard before the board. So what's happening is I'm getting a rebuttal from a doctor. It comes to me. The attorney says we're not going to have this heard. I want Dr. Chairman to look at this first. So I write another thing. If they don't agree, they'll write another thing. I've even had lawyers write rebuttals that I had to answer.
So we're just going to
And-
stack 6-month periods up until the person
No,
passes away?
this is how it's been done today. What this is suggesting
that's
is,
what we're trying to
yeah, that's what we're trying to fix.
Can I make a suggestion?
Yeah, sure.
A clarification. I mean, I think, and tell me if I've got this wrong, but I think what you're saying is not that we're going to give the member fewer opportunities to present information. We're just going to have the medical advisor only weigh in once. And so query of where does that leave the
I suppose
committee?
twice possible.
It's going to
Or
be
twice.
twice.
So, under today's construct, it comes to the committee, I think you're saying, where the medical advisor has had the final say, under a convoluted process where she's weighed in multiple times.
Exactly.
But it sounds like what you're proposing is not that you're not changing the number of times the member is gonna come. You're just presenting something to the committee where the last word on it was not the medical advisor. So query of whether that's just
Exactly,
gonna
that's
leave the committee saying, well, what does she think?
That's my point. That was my fear from the beginning. So if all this is going to happen is they're going to go back to the medical advisor, then this is a moot point. Well, ideally, if that happens, that will only happen once, as opposed to, I think the whole issue was that this was happening even before it was getting to the committee. So it was going back and forth. It's increasing our cost. She's having to write different opinions, even to the extent sometimes that the attorneys will actually write what the rebuttal is, even though they're not doctors. And then eventually, when, I think whenever the attorney then got enough information to say, okay, this have a good chance of being supported by the committee, we'll go to the committee. We're trying to stop that practice, which I completely agree with. And again, if I understand it correctly, she will issue her medical report with all the data that she has. The applicant with the attorney will get one shot of addressing that, and then the item will go to the committee, and the committee will then have her report, the latest report, and presumably they will ask the medical advisor at the committee, what's your view on this latest information? They will hear from the applicant and the attorney one more time, and then I will hope that in most cases, make a determination to then come to the board, or I'm assuming there will be times that they will be like, either we go to the board with no recommendation, or we need one more shot at this.
I hadn't really thought about it for Harvey, but I guess what we're doing is and I didn't get this before, Dr. Chairman, we're inserting a new formal appeal step, because they always have the right to appeal to the board, and if we don't institute this appeals, well, if we don't do it, Dr. Chairman's going to go nuts. But if we don't institute the appeal step, Harvey, this board's going to start hearing all these appeal cases, which is the whole reason why the committee exists. I hadn't really thought about that before, but that's essentially what it will work out to be. So the board still has that final say, so we're not breaking that part of the process.
But we're not going to keep, every time Dr. Tierman comes forward with an analysis based upon new rebuttal information or new medical information, we're not then going to allow the applicant to start a new 6-month
No,
period
that's what
of
we're trying to
shopping
stop.
back
That's
for
what we're
another.
trying to
They
stop.
get one
Okay,
shot now.
one
Right.
shot. I think
Right.
we can draft that.
Yeah.
I think we can write that into
Right.
the process.
Right.
That's just what I wanted to clarify is going to happen.
Yeah.
It's possible Dr. Timmerman will have to write a second opinion based upon any new rebuttal evidence that comes in after her first opinion, but then that will be it. And it'll go to the committee.
That's right, and if this board steps back, it's this classic Pareto thing. 80% of the cases are, hey, I'm a fireman, I got blown off a building, I broke my back, I get a disability. Bang, 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 right? And we have to go through the process, all documents. Dr. Tierman in her note says, yeah, the guy was blown off a building, he had surgery, and I can see him, he's really hurting. So that's easy. Then we get about 10 or 20% of the cases where it's a little bit gray. And that's some of these cases, not all of them, some of these cases get caught in that loop. And then there's probably one a year, and you'll see one soon, where even we can't. And Dr. Tierman can't quite sort it out. We can't quite sort it out. And so we punt, then the whole board will hear the case. So I think that makes sense, right? It's like,
I get it.
to be honest, Harvey, we're still exploring this sort of this gray zone. And I think Dr. Tierman is right. And part of the gray zone is, of course, medicine is moving underneath us.
Yeah, and one thing I do want to say is that for police and fire, these are workers' compensation cases. The attorney has all of those records, or they should have, because they have represented these people all the way through. And part of it is getting the medical records for the file. And one of the things we've done, Stacy, who is the analyst, who has done, is actually getting the medical records from workers' comp for the applicant as a courtesy, because they can get it quicker. So these aren't like obscure things. What takes a long time is the rebuttal, not new medical information. I mean, every once in a while, we can't get it from 20 years ago or 30 years ago. It's because sometimes they'll say they fell through a roof 30 years ago, and there's no medical records because they're gone. But that's rare. So the problem usually is not medical records.
So council, you're okay with this approach?
Sounds great.
I mean, the only difference here is that I think, as you indicated, there might be times where the committee may ask the medical advisor to issue a second report. There might be time that they had enough with that report and the attorney and the latest report, and then they can make a determination based on that.
I'll tell you one thing for certain, Council, this board is very happy to have a disability committee.
I would just say, I'm probably stating the obvious, but, I mean, it doesn't sound like you're suggesting that the member's opportunity to make the rebuttal is going to change. You're just not going to have the medical advisor weigh in again. So that means that you're shifting that responsibility to
Yeah,
the
it's like we're
committee.
formalizing the rebuttal appeal I hadn't thought about it. We're sort of adding an appeal step and formalizing the rebuttal process. And Dr. Chairman's right. It's right now, so catch as catch can, and that's not where we're going. Oh, final thought. So, Dr. Chairman wrote the note. Councilor Requeda said, works with him. We talked to the disability attorneys. They said, okay, 6 months. Roberto brings up, I think, the one salient point. Dick and I are in approval. And I beg the board to do this, otherwise you guys are going to start hearing disability cases again. And trust me, there's a reason why we created a disability committee.
But again, I want to answer your question. This does allow for the rebuttal, which is perfectly okay. But I think the main difference is that now it's going to be only once. Before, they were happening before I made it to the committee, and it could be 3, 4, or 5 times. That's a big difference between what we have now and what was happening before. That's all.
Isn't the rebuttal triggered by the committee asking?
No, these rebuttals were,
Well, yeah, the rebuttal, so if the attorney writes a rebuttal to what Tierman wrote, is it the committee that's going to say, could you address that? Or is it the attorney saying you could address that?
no,
Asking Tierman
the
to-
way it was happening, it was the attorney.
I know
Yeah.
that's how it was happening. I'm
Yeah.
just clarifying what we're saying. We're
Yeah.
saying that if
recommendation.
If Dick and Drew go,
The
yeah, we're
committee.
good with what we have, we don't need Dr. Tierman to write something, she does it.
Is the committee different? To me, the way I understand it is the committee determination.
Yes, okay, that's what I was.
Is that what you both understand, right?
and I
That's,
think
that's how I see it.
Dr. Chairman is saying, yeah, Dick and I are holding a stopwatch, and when that happens, we'll go 6 months and finish it, wrap it up, yeah.
Santos?
Thank you for the common sense approach. That's how I looked at it a long time ago after this hour debate. Really, to me, it was real simple. The board got petitioned by a complaint. And the board gave it to the disability committee. And we did all the information we did, since it was a board concern, because the board got a complaint, we give it back to the board for finding. Hello? Because the board was petitioned. It wasn't the disability committee. We know our job. And we could have easily said everything is fine. But Drew and I said, no, the board was petitioned, give it back to the board. And give them the information Dr. Chairman provided. Simple. Hour later, hello.
Well, with that said, do we have a motion?
Has every board member read everything? Does every board member understand what was said and done? It's up to the board.
You want to have a motion? I'll make it.
No, I'd be glad to, but again, that's why we did it to the board for discussion. Because that case would have been on the consent calendar, like Franco said, it would have been over. But we didn't, because the board was petitioned. The board needs to make a decision.
Mr. Chairman,
Yes.
I would say that the proposal as outlined in this memo does summarize everything we've heard. It does say there is a well-thought-out appeals process, but that Dr. Chairman will not be going round and round and round, that's all.
Correct.
So they have adequate amount of time. So I would say, I would second the motion that we adopt the proposal that's outlined in this memo, and this be made part of whatever formal process we have, whatever procedures we have.
So we got a motion by Lanza, second by Oswald. Any more discussion?
Just one thing, the most important thing was, did we have a fair process, did everybody get a chance to say something? That's what we made sure.
Mr. Chairman, do I understand correctly, the motion essentially is to amend our procedures consistent with the memorandum?
Yes.
That's exactly
That is
right.
correct.
Yes. All right, all in favor?
Aye.
Any opposed? All right, pass.
And Mr. Chair, I want to thank everybody because this is a healthy process to go through. It sends a message out there that everybody here is serious about disabilities, about how we spend money and what we do, and I appreciate it.
Dr. Tierman and Ross, thank you so much for your time. We appreciate it. You are free to hang up now unless you want to continue listening to us. That's fine.
Thank you.
Okay, bye-bye.
Who are we crediting the motion and the second to?
Motions by Lanza, seconds by Oswald.
Yes, thank you.
Thank you.
So, and I definitely appreciate everything the disability committee's doing, and yeah, I don't want that to be shipped back to this committee, to the board, you know. So, thank you for bringing this forward and clarifying it.
Because if you think investments take an hour,
Yes, I'm feeling disabled from the conversation.
We need to go back to 7.4B to receive and file the minutes.
Okay.
Also, we skipped over 7.4C, third quarter and fourth quarter 2019 detailed statistics report. Any discussion? If not, we'll just receive and file that. All right, receive and file. Which brings us to the JPC committee report out. Since Chair is not here, just give a little quick, we had a meeting, I believe it was last week, February 25th. We actually elected a chair, which was our own Vincent Seri. So he'll be chair of the JPC, and Elaine Orr from Federated will be vice chair. We spent 2 hours at that meeting really going over one of the items that was on the audit that came out of the city.
Grand jury?
The grand jury, thank you, the grand jury. And that was discussing the chair and, not chair and vice chair, the CEO and CIO performance evaluation policy and performance metrics. So we were just starting to visit that, looking at the evaluation process, what type of metrics that we want to develop and incorporate into that process. And so that pretty much spent about an hour and a half discussing that. We haven't made any decisions. We're going to try and meet every other month now from here on out to get this all put together. Because this is one item that we do have to report back to the grand jury by, I think July 1st or June 30th.
June 30th.
June 30th. So that's it on the JPC, and we'll go ahead and receive and file the minutes from October 2018. Proposed agendas next month. Are there any? All right, none. Public comments? All right. Meeting's adjourned. Good luck on the governance committee.
good job, Andrew.
Good job. 149.
There's no way in hell to, yeah.
Well, there's a lot of information up there. It came back a new ESG. That was,
Yeah.
To the trustees from the Federal Board, thank you so much for your patience.